Hey, well, thank you for watching the workshop. This is completely unedited. I wanted to make it like the actual workshop experience if you did miss a real one. So enjoy the video. Remember, nobody in this workshop is a financial advisor. Nothing said was financial advice. Please do your own research. And if you go to the comments, the pinned comment will be timestamps. Also, if you use the scroll bar, you can see timestamps and enjoy. I hope you enjoy. I really do. Okay, bye. All right, the recording is good. Everything else here is good. All right, so thank you everybody for showing up. Hope you enjoy the workshop. We're gonna get started with my section, which is pretty much just gonna be about lottos. I'm gonna kind of go all over the place. If you have any questions, feel free to let me know. Believe my screen's all good. All right, so let's get started. Lottos in general, for those who don't really get the term, is just short-term options. They could be out of the money. Most people prefer lottos as out of the money options that are weeklies, whether it's 2 days till expiration, 0 days till expiration. Personally, I just use the phrase lottos for higher risk options, which could be in the money or out of the money, but just short-term expiration. So that's really how I look at lottos. And basically in this workshop, I'm going to be talking about how I go about making money with lottos, cutting losses with lottos. I have a bunch of different points I'm going to bring up. To start, we're just going to go about how I find, trades that I want to take lottos on, and what I look for on the chart. So I'm sure you all have seen my videos and streams about swing trades, and that's when I stick with the daily and the 4-hour. When it comes to lottos, very rarely I'll use those time frames, and the only reason I'll use above the 1-hour time frame on lottos is just to find historical levels. So if let's go over to an Apple chart right now. So if we take a look at this Apple chart, let me clear it up really quickly. You can see on this chart that it's kind of retesting a previous high. So whatever you have, whatever your reason is for looking for that larger level, it can just help you manage your risk. So if you're able to find a larger level on a daily or 4-hour time frame, that could just be a level you trade all around. So we have that level chart on the daily. I'm going to make sure it shows on all my time frames. And really, I just do top-down strategy. I start with my higher time frames and I move to my lower time frames. So I'm really not too concerned with the technicals on the higher time frames if I'm trading lottos, but I just want to look for the bigger levels. So I already know that this 156.8 level is the big level I'm watching on Apple. Let's say I want to trade lottos on it. You can see it was a previous high and it's trying to flip into a support. So now I'm going to go down to my lower time frames, and very similarly to all the other time frames I look at and how I break them down, I'm just looking for multiple variables to line up, right? So if we're taking a look at this Apple chart, you could see it's been pulling back. We use fibs right here. You can see it's sitting at about a 50% retrace. So we're at a fib level and a historical level. If I take a look at my oscillators, you have the potential for hidden bullish divergence. So now I'm starting to see variables lining up. Once I see that, I know I might want to be trading calls on it. So I'm going to go down to even lower time frames and see what else I can find. So I see on this 30-minute time frame that there's a potential for hidden bullish, classic bullish divergence. Also that RSI is getting close to oversold. So I'm just looking for the technicals I usually do look for. I'm just going to scroll through all the time frames, see what else I can find, and really just try and create a story as to why it makes sense to trade lottos on whatever I want to. I could look for harmonics, whatever I usually look for. So for example, on this, really not a real harmonic right now, but it's close to a 78% retrace from this X point. We can create a demand line, supply line. So you're really just trying to chart out as many variables as possible. I'm sure a lot of you already know how I look for stuff like that. And really where most of my concern is on the 5-minute chart. Because when I'm in lottos, I'm very rarely going to be overnighting them. So the main time frame I'm playing is the 5-minute chart. So that's what I really want to understand more than any other time frame. So I'm pulling up to this 5-minute chart. I'm looking at Apple, and I already looked at my higher time frames. What do I see on this 5-minute chart? I can just look for more variables. You can chart a supply line however you want to over there. Maybe kind of look at this like a dragon with the lower low. But really, I'm not trying to get too deep into the technicals in this workshop because I've already talked about them for so long. I just want you to understand that I still look for the same things on lottos that I do for swings. Now, there's a couple other technical indicators I use in terms of picking lottos and what gives me a higher probability potentially. One of them is VWAP, which you can already see. It's already on my 5-minute charts. One of my favorite ways to play lottos is a move up to the VWAP. So if I see bullish variables on any time frame above the 5-minute, I'm really looking at that 5-minute to see, not necessarily if something's super extended under VWAP, but if it's starting to move up towards the VWAP and I already see bullish variables, it just potentially gives a higher probability that once that VWAP is broken above, it could create a larger move. And many day traders are going to be looking at the VWAP and trading solely off of that. So it's, you know, it's kind of a self-fulfilling prophecy where the VWAP is important, but also at the same time, it's one of the most popular day trading indicators. So when other people see a stock breaking above the VWAP, they might be buying it as well. So really, I'm trying to play above the around the VWAP, and the other indicator I'm using very often are Bollinger Bands. So what I look for on Bollinger Bands are two things. One, Bollinger Bands tightening, and two, the lower Bollinger Band, because I'm looking for reversals. A lot of people play Lottos where they find two levels. Let's say it's, I don't know, let me just clear this for a second. Let's say they put one level here and then they put one level here. And a lot of people will just trade Lottos where they get calls if it breaks above the upper level, and they'll get puts if it breaks above the lower level. Now that can work too. It's very quick. You know, I've seen that work in many different instances. But for me, I'm still trying to narrate the same story that I do on larger time frames, just on a lower time frame. So I'm still kind of trading the same way, where I'm designating either calls or puts just based on the technicals, not necessarily based on a break above or a break below a level. Because I think that's one thing that's been very popular with Lottos lately. You know, calls above X price, puts below Y price, whatever it is. But for me, if you can use those same technicals with some sort of a probability, you don't really just have to make it that simple. You can add more variables. So I'm looking for those Bollinger Bands. I can pull those back up again. You can see they're kind of tightened, and it's at the lower Bollinger Band. We take a look at the chart, we can see other instances where this hit the lower Bollinger Band and you saw a bounce, right? So you could see that all the way over here. So we have those higher time frames that are bullish. We're hitting lower Bollinger Bands, and you can see it's making those moves up to the VWAP, and the times in which it's able to break the VWAP allows for much larger moves. Over here, hit the lower Bollinger Band, went up to the VWAP, had a nice little bullish engulfing candle there, and this is where the majority of the move happened. So that's really what I'm looking for. You know, all of these little green circles I'm making are the potential areas where I could be taking profits based on my entries, right? Same thing over here. If it were to make a move up and I were to be getting into Lottos right over here, maybe I take profits around 158, right? You have your VWAP there, you have your upper Bollinger Band there, and you have a little bit of a historical level there on the 5-minute chart. So you're really trying to plan those levels ahead of time, and that's really what I'm looking for in terms of my entries. So that's just kind of the bare structure of the technicals I look for. On top of all of that, something I use very often on Lottos that I really don't look into too much on swings is volume. I really don't talk too much about volume on the stream, but I have talked about this. One thing I look for a little bit, where typically I don't like buying into the high of the day in terms of volume. So for an example, in the morning, right over here, Apple gapped down, and it was at the time the highest volume of the day. I mean, the day just started for Apple. I really don't look for buys over there. At the same time, I don't look for buys at the low of the day in volume, because a lot of the times I see technicals underperforming when you're at, you know, just insanely dry volume. So what I'm typically looking for in terms of volume on Lottos is relatively low volume, so it's a quiet area, but still increasing volume. So if we take a look over here, you can see you still had relatively low volume, but it was slightly increasing, right? As this dip was being created, your volume was slightly increasing even though it was relatively low. That's telling me that the interest for people to be trading Apple intraday is slightly growing, but it's not like it's at the point where people are FOMOing into it yet, right? Same thing over here, where if this stock is selling off on super high volume, that means a lot of people want to sell it. So I'm not really trying to catch a falling knife either. At the same time, I don't want to get the lowest volume of the day, because I might just be sitting there for 2 hours waiting for a move. And if we're in Lottos that have a short-term expiration, that theta is really going to start messing with your contracts. So I'm looking for increasing volume, but not FOMO volume. That's really what I'm looking for in volume. So just to summarize, I'm looking for larger levels on my higher time frames. Then I'm breaking down my lower time frames. I'm looking for my structural patterns on the 15-minute, maybe like a falling wedge or a harmonic. Then on the 5-minute, I'm watching the VWAP and the Bollinger Bands and the volume. Those are really how I look for technicals. And of course, there's a bunch of different things I didn't bring up, but it's kind of the same thing I would use on swings: harmonics, patterns, volume, any sort of indicators, your oscillators, all that different stuff. That's really how I'm looking for my Lottos. In terms of targets, I'm typically more conservative on day trades in general than I would be on swings. So let's say I was playing this. A textbook way to target this could just be a 50% retrace, which also lines up with the previous support you see over here. Maybe I leave like 1 or 2 contracts for that, but really I'm trying to get my profit and get out. So if I'm looking at this area first, maybe even the 382, I'm looking to get out quick as long as I'm in profit because those lottos could already be up a good amount. So I'm really not trying to be in these for a long time. If I am going to play larger targets, I'll probably scale out a good position, a good size of my position at the same time. So that brings us to just risk management in general. I think the first thing that's most important with lottos is just position sizing. You know, these are contracts that expire the same day. If some bad news comes out, the market starts falling. There's so many different instances in where even if you're right, you can be wrong. Even if you understand that, you know, a stock looks bullish and you think it's going to go up. If let's say you're 1 hour off, you can get, you know, your brokerage can close you out of those options, right? You get in calls at 2 p.m., your brokerage closes you out of them at 3 p.m., and then the actual move you were hoping for happens at 3:15 p.m., right? So you also have to make sure your timing is good. It's not just about, you know, being able to indicate whether it's going to go up or down. It's trying to time that as well, and that's where volume can help you a lot. In terms of positioning yourself for that, I can't, you know, give anybody financial advice, but for me, it's like if I'm putting money into lottos, it's going to be something I'm fully willing to risk if worse comes to worse, if the market just drops 1% out of nowhere and everything starts flushing. I want to make sure on top of everything, I've already put in money I'm willing to risk, but I'm not necessarily trying to risk all of that, right? I'm still trying to cut my loss if it makes sense. So for an example, this is not a, I'm just going to use a random number here. So let's say there's somebody with a $100 account, right? And let's say you want to put 1% of your account into lottos. So you put $1 into certain lottos. Now you could just be telling yourself, all right, if these work, I'm going to take profits. If they don't work, I'm going to lose 1% of my account.
I have not had a pumpkin donut, but I'm not going to.
Let me, Lump, if you see so that I can just mute them for a second, please. But where was I? So really, you know, if you're taking 1% of your account out and you're trading with $1 into those lottos, it doesn't mean you have to risk the full dollar. You could risk, I don't know, 25 cents of that, right? You can cut your loss at a 25% loss. But if you already are entering with a low position, it makes it a lot easier to cut your loss, because one thing is where if you over position size going into a lotto, it's going to be tough for you to cut your loss. And if you have any sort of hesitation to cut a loss on something that expires the same day, you can be down a lot more and very, very quickly. So for me, it's like if I'm already entering with something I'm willing to risk, that should mean that I shouldn't have a problem taking a loss at any percent. Whether it's a 60% loss, that's still better than losing 100% of whatever you had in that lotto. So for me, it's like I'm not too concerned about how much I'm down on lottos because I already know that I can risk the full amount. But I want to be able to be flexible where if I want to get out for whatever reason, I'm not stressing about cutting a whatever percent loss, because keeping some money is still better than losing all of it, right? So that's how I go about losses. Of course, I use the same thing. You know, if the variables I was watching disappear, if, you know, bullish divergence changes into bearish divergence, if volume starts dropping, if you fail to break the VWAP, all these different things can change throughout the trade, and that's where I can just take myself out of the trade. Same thing with stop losses. If I'm playing that historic level we talked about on the daily, I have no problem getting out of my lottos once that level breaks for whatever reason. In terms of scaling, it depends. If I'm playing a stock that's already at the support level, typically I won't actually scale. So for example, let's say Apple was testing that 156.38 level like it was on the low of this candle, and I was luckily watching it at that level. I probably would enter my full size. So going back to that example, let's say I was risking $1 because I have a $100 account. I'd probably just put in my full dollar into the contracts right over here. Just because I'm only playing that level. And if it breaks it, maybe I lose 20 cents on that buck. And I know $1 is kind of a weird number to be using for the examples, but just trying to break it down by percentage. So if I'm just playing one level and it's already at the level, I'll just do one entry, one sell. And even not for the sells. So maybe on the sells, I'll do 2 or 3 sells. But if I'm just playing variables, that's when I scale a lot. So if I have that dollar, which is intended for this trade, I'll probably do thirds or fourths. So I'll probably be entering at 33 cents, or 33-cent increments or 25-cent increments. Typically, I don't want to be scaling too much because then I might lose focus of the actual trade in itself, and I might start caring less about it if I'm just averaging so much. So you still want to try and be as pinpoint as possible, but you want to give yourself flexibility, because a lot of people really try to buy the low of the day and sell the high of the day. There's a very, very small probability in which you're going to be able to do that on every single trade. Even if you're a great technical analyst, it's not really only about technicals. You're just still going to get movement. And if you really try to overthink stuff like that, of course you want to pick your entries and sells to the best of your ability, but you also want to be using cost averaging to allow you to have a little bit of flexibility, because you still want to be focusing on said trade. So that's really how I just go about the charts on Lottos. At the same time, I'm always watching the market. I love when the indicators or my variables on the 5-minute for, let's say, the SPY line up with my trade, right? That's something I like to see. So I always have the market on another screen, whether it's the SPY or the Russell or the NASDAQ or the ARK, on one screen while I'm trading this, because I also in real time want to see if an index that matches my stock starts dropping. So for example, if I'm trading Apple and I'm looking at my NASDAQ on my other screen and the NASDAQ starts dropping before Apple does, maybe that can give me a little bit of an opportunity for arbitrage where, hey, I see tech stocks are starting to drop. Maybe that happens to Apple. Let me get out of my Lottos really quickly. And worst case scenario, I'm wrong. I could just re-enter at the same exact price if the price doesn't move. So you also want to keep in mind that you have to be looking at the market intraday, just to give you a slightly better edge. Because even if technicals look good on one particular asset, it could just be moving with a lot of other assets throughout the day. So market confluence could be good for entries if you see bullish variables on the markets. They could also help you get out before the individual stock drops itself if the market drops first. Especially when you're trading large caps, it can help a lot. On small caps, I see a lot of times it doesn't really match up perfectly. But on large caps, I mean, it's very typical that I see the SPY and Apple look pretty similar intraday. Same thing for a bunch of other large cap tech names. So that's another thing I'm watching. In terms of options picking and my Lottos, if I'm doing anything that's shorter than 3 days to expiration, I don't like going too far out of the money. The reason for that is because your theta is just going to be really, really high. And at that point, you'd rather just pick further out options, in my opinion. So when I'm playing anything that's pretty much like 3 days or less until expiration, I go slightly out of the money, at the money, or a little bit in the money. I'm not trying to go too deep in the money, because then again, what's the point of Lottos? You could just go play longer term options. So I think I took a screenshot that I can share right now. So right now we're looking at Apple, and this is two different. You have your price is 157.4. You're looking at one that's 10 cents out of the money, and then one that's about $2.40 in the money, right? So you can take a look at the theta is pretty much the same, right? Your gamma is the same. Your delta is going to be different. The premiums of those options are different. The open interest is vastly different as well. You can see there's a lot more people in these 155 calls than are in the 157, right? Volume also lower on this. So these are being traded more, right? So you have a lot of day traders in this. You're seeing the difference between options. But for me, I'd still rather go with the 155, even though this is only 10 cents out of the money. Because again, it is going to be a little bit more expensive, but there's more people that are holding these overall, right? So these are being traded a lot in and out. But let's say Apple starts dropping and it drops down to, that's right, 157.4 drops down to 155 again. Then these are $2.50 out of the money, and your trade potentially still could be valid. But even if it goes back up and it ends up closing the day at 157.49, you're losing all the money in those Lottos, right? So the closer and closer you get to it, that theta is going to start spreading apart if one of them is in the money, one of them is out of the money. So I just don't want to be in a situation where I buy a stock at 157.4, it actually goes up to 157.49. So I was right about the price going up, but it needed to go up 1 more cent for me to make money on out of the money calls. So I'm not against out of the money calls, especially if it's only 10 cents away and I'm looking for a larger move. But if it's going to be 2-3 days away, then I'd rather just, maybe give up a little bit of potential profit to be a little bit safer, that if I'm a little bit off on how much it goes up, it doesn't matter too much. And at the same time, typically I prefer, let's say it's a Lotto Friday, expirations are expiring. Typically I don't really, if I am going to be trading out of the money calls, I'm going to be doing that in the morning, and I'm going to try and get out of them as soon as possible. That's something you really want to keep in mind. The further out you get into the day, the higher and higher chance you have of that theta just crushing you. And you don't want to be in a scenario where the Greeks are overriding your thesis. You want the Greeks to be working alongside your thesis. And there's many, many situations where you can put yourself in which the contracts are helping you out. And I think 5150 can talk about that when he talks about spreads in a little bit. But that's just a very simple way about how I go at things. And I'm definitely not an expert with just all the different options terms. I understand all the Greeks and all these different terms, but really there's a lot of different ways you can break this down to put yourself in a situation where even if you're wrong, you're really limiting your risk. So that's why I think it's also important for all of you to go find your own options resources. So that's just how I would go about that. I'll give everybody like 5-10 seconds. If there's any questions about anything I just talked about, feel free to let me know. And take a sip of coffee.
What time do you normally place your Lotto trades? Is there a specific time of the day that you're looking for?
For me, if it's Monday through Thursday, I'm not too concerned. However, I really do like to play Lottos on Fridays. I just think there's typically a lot of good volume and options. So it just helps with spreads, but also if I am playing on a Friday, I really prefer, I'd say like, and this is an Eastern time, I'd say like the 10 o'clock to noon window. The 9:30 to 10 window is really where I'm just kind of looking at the intraday setups and how everything's moving. And then I want to get in early so I don't have to worry too much about getting closer to the end of the day. And then also I kind of stop around noon for a little bit because typically volume can start drying up. I mean, you can see a lot of different stocks where they're going to have their highs in volume for the day around the open and the close. And you just kind of have like this little U shape throughout as you have that lunchtime, just, you know, quietness and whatever it is. So 10 to 12 EST is kind of my favorite time on Fridays in terms of the rest of the days of the week. I still prefer mornings over afternoons in terms of lottos, but sometimes you do get a lot of better variables that show up in the afternoon because then you have a whole entire day's worth of data, right? So if you're trading lottos in the morning, you only have an hour or two worth of data on that 5-minute chart to see how people were trading that stock on that given day. But in the afternoon, you can have much more clearly developed patterns. You know, it's hard to find a 5-touch falling wedge on the 5-minute when you're an hour into the day. But when it's, you know, 5 or 6 hours into the day, it's much easier to find those. So it just depends on the day it is and then also how the volume's looking for the overall market.
And add on to that question, you want to wait 60 to 120 seconds after market open, depending on your broker, so that those option prices can actually settle in.
Yeah, I mean, you'll see a lot of gap ups and gap downs on the options. And I mean, you know a lot more about that than me and how that's calculated. But I've seen a lot of weird things around the open with options where, you know, the stock's up 2 or 3%, the options will go up only a little bit at first, and then they'll start really moving up because of the gap up. Like just a lot of weird things. I do see that quite often. So that's really how I look for lottos. That's how I go about picking them. Before we move on to Keanu, who's going to be speaking next, I want to open up TradyTix and talk about some other stuff. So let me get that opened here. Give me a second.
Quick question. How
go
far
ahead.
do you play out of the money options lottos?
It depends on, you know, what the share price is. Because, you know, for some stocks, $1 out of the money is going to be nothing. For others, it's going to be a huge move. So I look at it by percent. For me, you know, I try and see how much the stock has been moving throughout the week. I'm not too concerned about how much a stock was moving 2 or 3 weeks ago on average. But if we go back over to TradingView, if we take a look at this daily time from an Apple, we can just see the recent price action. It's been a little bit more volatile than pretty much this range. This range was just kind of going sideways. You had very, very small candles. But in the last week or so, Apple's been moving quite a bit. So if I see larger spread on those candles, I might be okay with going a little bit further out of the money. So it really just goes down to how the historical IV looks. That's another thing on TradyTix you could take a look at. But typically in periods of when a stock is more volatile, I'll go a little bit deeper out of the money. I can't really give you any fixed examples because, again, it depends on the stock price. But really, I'm just looking. Go ahead.
This is Keanu, but take a look at the volume there on that breakout from that rectangle you showed. That's higher volume than that, what, late October, right? That was a fake out, kind of created a new range. And then that range had a lower high, right?
Yep.
So it took out that lower high, and then it took out the top of that rectangle. And then look at the volume when that range was first created, right?
Yep.
On the left side, okay, there's the volume, right level. Then the volume when the rectangle busted out exceeded that. So that November 18th volume is more than what? October 30th, I want to say?
Yes.
Maybe
28th.
29th. Okay. Even the highest volume on October 29th did not top the volume on that breakaway, right?
Correct.
So you could have just said, hey, whenever the volume comes in, like, exactly. Yep. And let's say we didn't look at all at the price action whatsoever. We only looked at volume only. You'd be like, I think it probably broke up with that volume. And then you would zoom out to the price action and see that that's exactly what happened.
Yeah, great point. I mean, volume in general is so important on lottos. I mean, technicals, of course. I mean, for me, when I'm looking at daily and 4-hour timeframes on swings, I think the main reason I don't focus too much on overall volume is because I'm more concerned with the actual company news short term and the actual shorter term technicals. And a lot of the times I'm looking for major reversals on swings. So sometimes I have no problem with if it's like the lowest volume of the year getting into a swing, because to me it could be an indication that it's just a very, very quiet time. And for me, I mean, I've heard a lot, I'm sure a lot of you have heard this saying, but you know, buy when things are quiet, sell when everybody's FOMOing into it and stuff like that. There's a lot of different variations of that saying, but yeah, I mean, looking for volume on breakouts is necessary. And just confirmation in general, that was another good point. Maybe you could touch on it because you're speaking next, but confirmation with volume, confirmation with candle closes, waiting for those setups to confirm is so, so important, because especially intraday, you're going to be dealing with a lot of fake outs. And as a lotto trader, a fake out can completely ruin your trade. But like you said over here, let's say you were trading Apple on the daily time frame. Just because it faked out over here, you could still be in profit, right? And this is why I prefer reversal trading rather than breakout trading, because when you're trying to trade breakouts, there's going to be a lot of different fake outs, and then you're at a loss when the stock is consolidating. I'd rather be sitting in a profit during a fake out than sitting at a loss because I was waiting for a breakout to occur. So that was a good point right there.
That flag from like October, you know what, 18th or so, that breakout below on the bottom left of the yellow triangle. So that breakout, yeah, that was retested where you first drew the top of that line into, it popped out to a breakout. Then that price action held into a flag, popped up, and then it broke down under the flag. Okay, so the volume took you up there. Then let's take a look at, as we keep going through the days, we have what, November maybe 8th or 5th with the lower high. Okay, the 5th I think it was. We have that lower high, and look at the volume. The volume is not there at all. Okay, so options trader can look at that and say, we are testing the highs of this triangle with rectangle with no relative volume whatsoever. So short traders are just salivating at the mouth there because they know it's going to come down, and it was able to hold the rectangle. But look at the volume where Champ has his, you know, the November 4th line. The volume is so low. So price action's moving up on no volume whatsoever. That is, shorts target that like crazy. You don't want to be caught with them. So that's all I wanted to point out there.
No, great points. Thank you. So yeah, KeanuTrades will probably be talking a little bit more in a few minutes. I just have one last thing I want to talk about before we move on to the other speakers, which is just options flow. Let me log in really quickly. 1 second.
I can't see. You're off screen now. I can't see you typing in your password, Champ.
What'd you say?
Oh, okay.
Neutron?
Making a joke.
Oh.
You're saying he can't see you typing in your password.
Okay. So let's go over live options flow. So let's take a look at Apple, right? So let's say you wanted to buy calls. I mean, you could use whatever platform you want. I like TradyTicks the best. First off, calls to puts is around 70%. That's a good indication to me. And of course, a lot of these are going to be longer term, but again, if you're trading lottos, one thing I always like to do is filter by out of the money and short expiration. So even over here, you have 80% calls to puts. That's one of the things I always look at. You can look into the options flow in general, but calls to puts in the short term is another very, very good indication that a lot of other people are going to be using. And again, another self-fulfilling prophecy where a lot of people are buying calls, and then a lot of people see a lot of people are buying calls. It creates this cyclical effect, right? Or this ripple effect. So I'm looking for that as well. And then also another thing I'm looking for is those higher premiums short term. So for example, if I see high premiums on the same exact option I'm playing lottos on that just came across on my scanner, that's a good indication that other people are seeing the same thing that I am. So for me, looking at live options flow is a really good way to find confirmation that other market participants are seeing the same things that you are. On the flip side, if you see that other people are taking the opposite bet as you, it puts you in a situation where you could kind of see, all right, maybe am I a little bit off, or at the same time, maybe other people are off, and it just helps you double think things. And I think thinking more is always important. I'm not saying you should ever overthink, but really using option scanners is a good way just to get validity or just other people's opinions instead of going around and trying to ask everybody, hey, what do you think about this? I mean, this is mathematically going to be telling you how the price is moving because this is how people are trading it, right? And of course, these are options. It's not actually shares moving, but typically you're going to have a very similar, cost to puts versus the actual price. So that's another thing I'm going to be looking at. Also, of course, you want to be looking for sweeps. You want to see if people want to get into that right away. There's been many times, I don't know if any premium members are in here, but we've traded Clover calls a lot. And one thing, there's been a lot of times where I'm looking for a nice move on Clove calls, and I see good intraday price action that, gives me variables that maybe the price could go up. But what happens sometimes is I come over to the scanner and I look at the short-term expiration out of the money, and sometimes I see put sweeps for those same exact expirations. So sometimes when I see that, I just don't take the trade because other people are really betting against it, right? I'd rather be in a room where everybody thinks the same way that I do than people having mixed emotions, right? You want to be in a trade where overall market thesis for that stock is in your favor. Trying to bet against everybody else is going to work here and there, especially if you're a good trader. But you want to be in a room where if everybody's thinking the same thing and you're thinking the same thing, one, position yourself early, and then two, make sure you're not going to be too emotional about that, right? You don't want to be in trade longer for everybody else. The last one to leave the trade is going to be the one holding the bag. So I use options flow very, very simply. There's a lot of different things you can do with options flow, but I just want to make sure I got that point across where you should be finding some sort of a platform that provides you with just very short-term statistics if you're trading lottos. So yeah, that was pretty much.
What's the difference?
Go ahead.
Sorry. What's the difference between sweeps and splits?
Sweeps are just when people are buying above the ask. I talked about it on one of my streams, but I could do it very quickly. Let's say the stock price is this, or the bid price, or the middle price is this white line. This red line is going to be your ask, and then this green line is going to be your bid. When people are getting into sweeps, they're buying, let me make this yellow, they're buying the ask price, which means they want to get filled immediately at an unoptimal price. I don't even know if that's a real word, but they're trying to get filled immediately, even though it's not an optimal price to be getting filled at. So that means that they want to get into those calls or puts very, very quickly because they have a very strong opinion about that trade working out. And then in terms of splits, I actually don't know. I'm sure one of the other speakers here could help me out here. Or anybody here, if you know what splits are, feel free.
I think splits are just when it's not all above the ask, there's some below. It's not uniform. If I'm wrong, all right, but that's what I was told.
So they're kind of like splitting up their order?
Yeah, splitting up the order.
Yeah, that makes sense. So yeah, that was pretty much my segment and how I look for lottos. So just to recap, or not to recap, but to give you the rundown for the rest of the workshop. Up next, we're going to be having KeanuTrades talk about short time frame patterns for about 15 minutes. Then we're going to have 5150 talk about spreads for maybe half an hour. Neutron's going to be talking about orders and scripts for 20 minutes. And then Mehdi and Lump are going to be talking about their new scanner system for about 20 minutes. So I'm going to pass the microphone over to KeanuTrades if you want to share your screen and go for it. I'll still be here.
Thanks,
I'm just going to mute myself. Go ahead.
Thanks, Champ.
You hear me?
Yeah. Let me see. I'm sharing my screen right now. Can you guys hear me all right?
Yep.
Yep.
Cool. Let's see. All right. So I'm going to have this up on another screen here, even when I'm not presenting. So somebody kind of made a joke about Champ buying those solo cars that he hates so much, which is fine.
Oh, gosh.
Yep. Those are, I don't think he would fit in there, man. How tall are you?
I'm only 5'9", so I would fit in it, but you're never going to see me in one.
You might have to do that Ace Ventura, sticking your head out the window. It's small. So, and then we got this poll here. I'm going to go over bull flags a little bit. But shooting star, good to know for the next time. I don't have that in here, but I can toggle between the two. I am going to have these questions up because it's hard for me to look at the Discord stream and the Discord chat, but I will have both up. So, alrighty. Let me go to my other screen here. change windows. All right. All right, so you guys can see my Google thing. Oop. Where's that? There we go. Okay, so I have this link here. If you go to this tiny.cc/KT patterns, you can have
I don't think you're sharing the right screen.
Oh, okay.
You'll see the solo question.
All right, let me.
I see it. Yeah, I saw it.
I see your Google Slides right now.
Yep.
You see Google Slides? Okay, cool.
Yeah.
Oh, oops. Okay.
Maybe it was a little bit lagging or something. You guys good on the price action patterns?
Yep. See it.
I spent all morning putting that matrix background. It all ties in. See. So yeah, if you go to this tiny.cc link, it'll make a copy. You will have this. So don't worry about that. But so this is not channel trading, which Champ doesn't go over that too much. But I know there's a lot of channel trading, which is very profitable, and he does a lot of the divergence trading. But this is not based on any of that. Now, when Champ was talking about Tesla is in bearish classic hidden divergence, I was like, man, everything is pointing to Tesla going up, but every stream, right? It was like weeks, bearish, but Tesla just broke out of that. And, you know, we made some good money there. So Champ did not jump into puts because he saw the bearish divergence. He had to wait for the pattern to develop and all the things he's talking about. And if somebody watched his stream, or if he would have just jumped into puts because of that hidden classic bearish divergence, he would have gotten destroyed. So as soon as it broke out of that, it ran like $400. Okay, so you have to use multiple measures here. You can't just use one. And so what I do is the bottom here, I wait for high percentage patterns to develop. And the bigger the time frame, the better, because the bigger the move. Okay, I know some people watch the 1 minute. And if you have a 1 minute bull flag, the flag probably only going to last a minute. All right. But if you're looking at the hourly, the 4 hourly, you're going to get a bigger move. All right. So, just some more information here. I'm a patterns based trader. I sit on volatile tickers and I just wait for these to develop. I do not click, you know, what's Boeing doing? What's Disney doing? What's, you know, Beyond doing? I just sit on Tesla, Facebook, SPY. I put Roku there because that was my old baby, but I don't really trade Roku now because it's been just falling and the spreads have been getting worse and worse as volume has come out of it. So you cannot trade things that don't have that volume, as Champ was saying, because the spreads will just kill you. You try to scalp a spread and you will get destroyed because a lot of times you have to mark it out, especially on a Lotto. And good luck with that. So pretend like Roku isn't even there. All right. Now,
the liquidity.
Exactly. I love SPY. If you're new or don't know options, just erase your watch list and watch SPY. That would be my best advice, because it's a $1 spread. You know. Now I look for bullish patterns above VWAP and the 200 EMA, and bearish patterns below them. And then, of course, like Champ was saying, the market sentiment has to be there. I'm not going long if we're having a major red day, unless everything's starting to curl and bottom, but that's usually late morning, and you know, that's a different thing. But let's see. Volume's everything. And that's why I kind of stepped on Champ's toes there a little bit, but I didn't want him to get out of that screen when he was looking at the Apple chart, because volume was everything. If you just put like a piece of paper maybe over the chart he was looking at, volume just dictated everything he was saying above on the price action. You don't know which way, if it's up or down, but you know it's breaking up or down based on that volume. All right, so that was really cool to see. Okay, so here's the first and like probably the easiest pattern. This is from my buddy Bueller. I pump Bueller all the time because he taught me everything I know, and so he's just a freaking rock star. He's not on Twitter a ton. He's like Instagram, Discord, but he is one of the GOATs. And so one of the easiest patterns here, 3-bar play. All right. It's just like, hey, how long was the war? When was the War of 1812? It was in 1812. Okay. 3-bar play is obviously 3 bars. It can develop into 4 and 5, and that becomes more of a flag. But a lot of times there's this ignite candle, up or down. Then you have the baby candle, okay? And then you just have that breakout. And right when it breaks out above that, you know, decisive candle in the middle, you just get in. Okay, so my buddy Tops, he made that LGVN chart, which does not have options. Okay, so I have actually one chart that does not have options. You can play commons here. And right when it starts to curl, you're like, is it curling or is it a fake out? Then we get that confirmation candle. Okay, and it's okay to miss that first move, because if it's really curling and Momo's pouring in, you can just get the next 3-bar play. Okay, and flags fail when the 3-bar play goes down, and it just invalidates that flag. So watch volume below, because as we saw on Champ's Apple chart, if that candle that is confirming does not have volume, I'm not playing it, because that confirmation candle will become a wick and you will get destroyed on the reversal, especially on Lottos. Okay, so if the volume isn't doing where it says in volume indication, I'm not in. I will just watch other people make money and say, hey, I'm not doing that. I don't mind, you know, missing out on that, because I have to have the volume to feel confident in it, or else I'm sweating. All right, so this is just a quick one that's very self-explanatory. I'm not looking at, you know, divergences, MACD, or anything. I'm looking at price action, right? 5-minute. This works on any time frame. So the lower the time frame, the quicker you must take profits. The more out of the money your options are, the quicker you must take profits. If Champ was getting that Apple in the money call, and Apple keeps running, he can just hold it all day. He can hold that until he's forced to sell it by Robinhood, or, you know, if he has TOS, he could just sell it 5 minutes before end of day. But if you have something out of the money, you can't just ride it like that. I mean, maybe, but it's just not a high percentage play, right? It's only the ones that are like, wow, AMD really ran today. You know, good luck being in that ticker out of the thousands. Maybe it'll happen. Okay, so here we go. Ascending triangle. This is my favorite play, because as you can see on my iPhone there, that yellow pattern, I just draw it all the time. Take a screenshot and draw it. All right, and when you draw that pattern on your iPhone and just wait for 1 second, it makes the triangle automatically. Okay, so I don't like sit there drawing perfect triangles. It does that. So these broke out, and I have the thing on the right that says textbook reality. It does not always look perfect. There are fake breakouts, just like, again, Champ's Apple chart. That mini rectangle looked to be breaking out, and it came back and retested and created that rectangle that he highlighted in yellow. Okay, so people were definitely caught in that breakout. Maybe some people profited when it went up. They scaled out. But if people were trading that breakout, they just got destroyed on the retest, and that just happens. I do not have on that textbook versus reality graphic the volume, but based on what we've talked about here, we could already draw the volume, right? We know the volume went up when it broke out, and the volume went up when it came back in. Those long candles always match volume.
You probably have a U shape there off of the first fake breakout like he showed before, and then the volume came down until you had the next breakout.
Exactly. I would be willing to bet that that's exactly what happened. And here's another thing. You should be able to flip charts completely upside down. I would love to see Champ maybe do that and say, hey, what is this upside down? And say, this was Apple upside down for the last week or something. Okay. There's something called a descending triangle, which is obviously the opposite. And those usually break down. You don't want to be in that. So, and how if that fake breakout happens, it can fake break down and come right back in the triangle. It happens all the time with uptrend lines. It comes down, it wicks back into the pattern or channel, and you just keep riding it. So this was on the left side from Friday, I think. I don't remember, it could have been Thursday, but the price action was happening, and I sent this to Champ, and I was like, hey, it was at what, 20 maybe 18, and it just went up to 1125. And this is also the 5-minute chart. I'm not going to expect a 50-point move. So, and what is price action? It's just a display of people's buying and selling. That's all it is watching it. So on an ascending triangle, people are buying, and then they're not letting it go further. Like let's say where it says textbook, that's where I'm looking right now. So it goes up to, let's say 1100, okay? Or let's call it 100. Then it comes down to, let's say 80, goes back up to 100, down to 90, back up to 100, down to 95, back up to 100, down to 92. See that range dropping? And then once it gets to 100, people start buying 102 back to 100, and then it launches. So they're saying people are not buying at 100, and then eventually they are. So that's what's happening here. You're literally watching people's buying patterns. So here's another little flag. It's just called, this is a flag, pennant or bull flag, or there's flags or pennants, okay? They are not always perfect. As we see in the middle there, it's a little bit crooked. Someone just said, is there a place to view my screen? Can you guys see it?
Yeah, I see your screen. You have to go and click on it. If you're in the chat, go up to Keanu and then watch.
So we have some different patterns there. Let's look at the right-hand side. Like these are just screen grabs from my phone, but I'm watching that pennant turn into a falling wedge, okay? And if you have two shapes on top of another, it's even more confirming. So we have 112, 113, whatever that was, and then it bounced up. It's a little candle, but Tesla moves. So then we go $3, and that just kept going for the rest of the day, if I remember correctly. Okay, and then we have SPY in the middle doing the same thing. The bottom is holding, okay, and then the top busts out, and it could bust down, okay, if the volume dries out or whatever. Like you have to wait for the breakout, and I just wait for the volume. Let's take a look here. Can you guys see my mouse moving?
No.
Okay, so I'm looking at the SPY chart in the middle, maybe about 9:30, right when that yellow triangle busted out. Take a look at the volume down below. The volume busted out with it, okay? So the volume confirmed the move, and it's going on up. And then it went to the top of that triangle. So you actually have a next move here, but anyway, the volume totally confirmed what happened there. And if we look at when this flag first started, there's no volume there, really. That's why it stayed in this range. So next one, and we'll be done here.
Before we go on, do you mind going back a slide?
Yeah.
So right there, if we were just trading at 9:30, I won't be able to see that candle close or that volume bar, or I won't be able to see that volume bar until the candle actually closes. So when do you enter?
So I would enter on the retest here of that. If you look at how to trade the pennant pattern, do you see how it breaks out and then it retests against the triangle, whether up or down?
Yep.
It says bullish breakout, bullish breakdown. Okay, so if we look at the SPY pattern, it breaks out with volume. Now it's on our radar. Okay, we don't know what's going to happen, but we're watching for more volume, more confirmation. We have an indecisive little bit of a, I'm not going to call it a hammer, but maybe a doji / hammer. And then we're like, is this going to retest down? Is it going to just be flat? And then the very next candle busts above it. And what does it look like?
Looks
a
cool.
mini 3-bar play right on top of that breakout.
I guess the other way of asking it, that I think will be more direct, is do you wait for the candle close to confirm the volume?
I do if it's close, because the candle body has to confirm over my triangle that I drew. If it's the wick, that is not confirming. So yeah, I am looking at, hey, this is a 5-minute candle. I don't want to trade a 5-minute candle at 10:06 because I have 4 minutes to go on that candle.
Cool,
okay,
thanks.
Cool. All right, so this is something that this is from the right side of the page, that green triangle. So I brought that to the middle here because that pennant turned into a rising wedge. I'm sorry, a falling wedge, and it busted out. That's exactly what happened. Do I have it there? Yeah. So, and that's on the left side. That ascending triangle turned into that wedge. But on the right side here, I have the hourly chart. Zoom in. Yeah, hourly chart. So this Intel was falling day after day hourly. Okay. Daily as well, but it was easier to see in the hourly. And it was testing a previous resist level that turned support. And I didn't know if it was going to break down or what, but it was in a wedge and it just went right up. So right at open, I got calls because it was respecting that line. That wasn't a small time frame or a lotto, but I just wanted to show that this can work with other time frames. So, and I think that might be it. There we go. So if you want to join me for more of this, I'm not as technical as Champ. He's got crazy patterns following animals I've never heard of and divergences I have to Google, but we have some 3-bar plays and wedges and triangles and make money, baby. So, and I appreciate being asked to do this. And Champ's doing a big thing, man. I'm gonna be following him forever when he buys his Lambo. I want to watch all that. So appreciate you guys.
Thanks, Keanu. Everybody see my screen here? Just one person. Okay, so we're going to talk about is most traders who are new. You can see I don't know if you can see the mouse, but I have a balance over here, $10,000. Okay, where options trading and credit spreads come into play, and what, in my opinion, is the best purpose for them is for people with smaller accounts. Because what it allows you to do, it allows you to define your risk prior to entry, and it also allows you to maximize leverage, okay? And a lot of times when you talk about leverage is bad. Well, in options world, I don't think it's bad. I think it's actually a way to predefine what your reward or your risk can be, and that's what we're going to go through, okay? So if you have a smaller account, this is actually one of the best ways to reduce your risk, okay, in trading. So a lot of the times when you guys are looking at trades, we can use Apple as an example because it's one of the most liquid stocks, okay? And you have a pattern that you want to play, you have a target, you have a risk-reward ratio that Champ has given you from a swing play, whether that's 3-to-1. Okay, so in this case, what we're going to look for is we're going to look for a way to, one, define our risk and play something as far as an options trade with a predefined area. And I'm going to show you how to do that. So let's say we have a pattern at 160 on Apple and we think it's going to go to 175. And our time frame on that is, let's say, 30 days. Okay, so the example being on that is you could buy 100 shares. 100 shares of Apple at $160. I don't know a lot of people that can afford that. And also the fact that a risk-reward ratio on that is, if you want to define that, if it goes up $15 on that, you can define your risk and your reward on that. So what we would do in this case, or what I would do, is I would come over to the options chain. Hopefully you guys can see this. And I would look for where my open interest, what is the highest strike price for these dates. I'm at a strike date of 17. So the example here, do we think this is going to be 30 days or do we want to go out farther? Well, I can come back up here and I can look at the implied volatility over here. Can anybody see my mouse when I'm doing this?
Yes.
Okay,
Yeah.
perfect. Okay. So this is your implied volatility, okay? This is what makes or breaks options prices, all right? The higher the implied volatility, the higher the options prices are going to be, okay? So when I'm looking at this, I can come over here and I can say, okay, well, that's 34 for January and it's 35. So they're relatively the same. And playing spreads, the implied volatility necessarily doesn't always define what your trade can be because you're selling it as well as buying it. So you're offsetting it. So in this case, we're going to be looking for the strikes. Okay, we got 160. A lot of times you guys are going to be buying out of the money calls. You're looking at this and you're saying, well, my target's 175 and I can risk $200 on a trade. Okay, so great. But if you look at this $200, if you're going to buy an out of the money call at 175, and you come over here and you look at your delta's 20. Okay, that's basically telling you that you're going to finish out of the money 80% of the time. Okay, And you can see that by the probability of in the money on this trade at 16%. So really what you're paying for is the right to own those shares at 170, but you're hoping that the volatility goes up and the price goes up, and that way you can cash out those shares. So instead of doing that, and let's say your risk is $200, well, you could buy a 155 call right here. So we'll go ahead and we'll try to buy that. We'll pop this down, okay? And let's say we want to only risk $200 in this case. Well, I could actually sell this call right above it, okay? So now I have what's a credit spread. Okay, we'll bring this down to make it simple. So here's my risk. My total risk right there is $238 per contract, okay? So that's going to help you. So you just bought a contract of a 155 and for 885, and then you sold a contract for 595. So you're actually collecting this 595 back. So if you're going to confirm it, so your risk reward on this trade is 262 with your max loss of 238. Now, doesn't sound very sexy to me. So I would probably try to find something else, right? I'm looking for a high probability or something of a 3-to-1 nature where my risk reward is higher and my cost is lower. So I'm going to share another screen with you guys. Let me see how I can do that. Hold on, let me figure out how to share the other screen here. Yep, should be on here. You guys see this screen over here now? Okay, so this is a calculator. It's an options profit calculator that you can use. It's really simple, okay? You can come over here and you can type in the price for Apple, hit Apple. You can play around with this, so we can come up here and we can say, okay, well, we're looking for, let's say we're going to look for the January calls, okay? So we're going to buy a YOLO call or a Lotto call, and let's say we're going to buy 175, okay, just to give you some idea. So that they're saying it's 49 cents a contract for a 175. You can calculate it right here, and it'll say, okay, your entry cost is this, so you're paying $49. You're infinite on your upside risk. So yeah, if it was 200 or 400, you're going to be maximizing gains on that. But is it really going to go up there? Your probability of profit is 6%. Okay, so your probability of profit is very low in this situation. That's for December. So if I wanted to go to, if I did the January one, and we did the 175, just to give you some more time. I'm just giving you guys these as an example too. So you're talking about 194 at 175. It's saying, okay, we have a 15% risk. So yeah, your upside's there, but your 15% probability of profit, that's not very high. So I'm going to try to avoid that. So what I'm going to try to do is I'm going to try to gain premium. So in this case, Apple. Okay. So now I have a spread option. So let's say my target again is 175. So I can come back down here. I could say, well, I want to give it time because I think it's going to take 30 days or so to play out, right? And the better theta is going to be options that are over 30 days. Once you start going under 30 days, your theta starts to increase and your contract and your time start to decay against you. So it's actually working against you. So, and my spread plays or swing trades, I like to give it a little bit more time. There's less volatility when it comes to that. You might be paying a little bit more, but I have more time in case something goes wrong. So in this case, we're going to have the Januaries. We're going to say, let's look at the options prices here. You can come down, you can say, okay, well, these are 885, so it's at 160. So let's just say we're going to do 160. That's just right outside the money. And let's say we want to sell the 175, and let's see what type of probability it gives us. Okay. Now, I'm paying 610. That's per contract. Okay. And then I'm writing a contract for 194. So I'm collecting this back if I do this. So you could take 610 and minus 194 to get your overall cost, which is 416. Okay. So now I have a 35% probability of profit, and my max return on risk is 260. So that's pretty close. I would like to see this a little higher if I could, at maybe a 3-to-1 risk reward ratio for swing trades. I don't mind this, keeping this around anywhere above 30. I could prefer, but then this is giving me an option. Now you say, okay, well, I'm risking 416, right? And Champ talked about this earlier. Well, I mean, yes, technically you're risking that, but I can sell that and get out early and recoup the funds. Okay. Here's the great thing about this. Let's say you bought that 160 call, and let's say for the next 20 days, right, it goes nowhere. It goes backwards, right? The entire process of the time, you're gaining money on this call that you then sold. All right, because as time decays, this price is going down, and this price is going down. So it's actually helping you offset. So your losses are actually not as high as it would be if you were to just lotto this right here at 610, right? Because you're actually gaining premium as this comes back down. So let's say this gets back down in that 30 days, and this is actually $1. You could buy that back, collecting the $94 as profit to use against this that you've lost, now offsetting it. Now you have a YOLO call or a lotto call again. So if you think that, okay, you've got hidden bullish divergence, it's on the 4 hour, it's at a price point where you think it's going to reverse, you could buy back this call, wait for it to go back up with volume or, you know, a pattern like Keanu talked about, and then, we're reaching a resistance point. Let me go back in there and sell this call again to somebody. You can keep trading this inside and out. The reason that this is such a great way as far as options goes, because you're defining what your risk is up front, and you're defining what your maximum gain is up front. So going into this trade, I don't need a stop loss. I don't need anything else, right? I don't have to worry about the trade. If 5 days in a row we have a red day, well, I'm not over, right? I already have my loss. I have my gain. I don't have to worry about it, you know, a scam wick stopping me out or anything like that. You know, boom, it's right there in front of me. I've already have it predefined. I can move on to the next trade.
What are the risks associated with being assigned?
You talking about like having an option exercised against you?
Yeah.
Well, you're selling an out of the money call in this situation. So if it does exercise on you, it would have to be in the money. So example being, you would have to wait until the expiration date, most likely, because nobody's going to exercise the call on you prior, right? For the most part, right? Unless you're way in the money, like, you know, then they might do it. But at the same time, you know, you're still gaining that as far as if you're the choice of exercising the 160 call. Like, you know, somebody else isn't going to exercise it for you if you're in the money in that situation. Now, if it's, let's say the stock runs up to 180, right? Yeah, sure, they can exercise that, but you have a call to cover it at 160. You're capping your gains at 175. So anything over 175, you're not gaining any profit on it, right? So I mean, but yes, that's the bad part. But do you really think it's going to go over that time period and, you know, and make a move of that? It's possible, it could happen, right? But it's a low probability play. So and if I really got into it at that point, and I think, okay, we're going to go 200, I could buy back the 175 call again, and I'm still collecting profit, right? You're not losing anything at that point. So, hopefully that helps.
Even if it ends up going to 180, because what you end up paying for the call or the spread is less than paying $6 for the call by itself, probably still going to make more money with the spread. It'd have to go to like 200 or 210 in order for you to start losing money on the spread.
Yeah. I mean, you're always making money on it from that perspective. It's not going to lose anything. The whole point of doing spreads is really to define your risk. So this is kind of an easy way. This is the way that a lot of new traders, you know, when you look at options, you should be looking at doing a spread, because, you know, doing just a one single call, which is what a lot of people do, because they look at it and they say, they come over here. Let me go back to the other screen here. Hang on. Let me go back. Okay.
But spreads would be more useful for swing trades, right? Not necessarily day trading. That'd be a lot of.
See, yes and no, and I'll explain that. That's a little bit more higher level, okay? So these type of swing trades right here are better for, or these type of options are better for swing trades right here, okay? But the great thing is I can actually play the options a lot of different ways. So I can actually sell into it as well. So example being that chart that Champ had of Apple, right? Let me see here if I can pull up a chart here for you, and we could do it on Apple. Hang on. Hang on, let me pull my screen up again. All right, so you guys can see my screen now, right, where it has Apple on here? Okay. So another way that I can trade spreads is this right here, okay? You see the D point on here where there's, you know, I'm thinking there's a harmonic, it's at an upsloping wedge or a triangle, it's at a resistance point, okay? So this is also an area where I could actually sell calls into that. So I could do a short by selling calls and collect premium on that, where I'm saying, okay, you know what, it's at 160. I don't think it's going to go above 160. I think it's going to come back down from there. I can sell a 165 call and collect the premium on that, and then not even worry about it as long as it's not over 165, right? So
if you think it's going to reverse, wouldn't it be interesting to just sell the call instead of buying? Oh, sorry, sell the call you already have instead of selling a call deeper out of the money.
Well, see, I would sell a call at the 165 area because it's right above where the resistance area is. So when I'm doing that, I'm not actually trading it. I'm doing it for the sole purpose of collecting premium. So that's a different type of a trade. It's a little bit higher level. We can get into that as well down the road. But as far as like with the basics on the credit spreads, I would stick with just doing the swing trading styles. If you want to do day trading styles on them, you can do them, but you're not going to want to do them where you're doing the same day ones. I wouldn't suggest doing them that way because yeah, you can get exercised on it and have to buy the shares. And if you're not paying attention, you know, then you're going to have it exercised and you're going to pay exercising fees and things like that where you don't need to. So, in these cases, the best way to play the spreads for swings is kind of like how I showed you, where you're selling into it and you're really just doing it to reduce your overall risk that's in the trade. Okay. You can get into higher probability trades where I'll show you one example being, I'm going to go back to a different screen here. I'm going to show you another example of a way that we can do these that I really like to do. And it's basically what I would do is I would sell into it and collect premium to buy my long call. Okay, so in this case, we're going to go over to a three-leg option. So you have to play around with it a little bit, but okay. So we're going to pop in Apple. Let's say Apple's got a support area at 160, right? I don't think it's going to come lower than 160. So in this case, I'm going to say I could go December 17th. I think, okay, well, 160 is the top area right there. So I'm going to say, okay, I'm going to buy the 157. Okay. So I'm going to buy the 157. I'm going to sell an option. I'm going to sell the 160. Okay. And my whole purpose here is to collect premium. Okay. 432 minus 330. Right. So now I have $1.02 in premium that I have right there. So what I can do is I can say, okay, it's not going to go lower than 160 by December 17th. But what it's going to do, I think, is it's going to go up to 170. All right. So now I have $1 in premium. So I have 90 cents right there at 170. Okay. So I've bought in a call right here. So I'm saying basically at this 157.50 is my stop loss, is my protection. Okay. Because I'm going to sell a call. A lot of people look at this and they're, oh, you're selling it. You're naked. You're open. No, and your broker probably will not let you sell naked options, so you shouldn't worry about that unless you're on Robinhood. Robinhood probably will let you do it because they don't care. So I'm protected on selling this 160 call if it does break. This is going to be my stop loss right here. Okay, so if you were to take a option that was on Apple and it cost you $2 a contract, and you said, well, I'm willing to risk $2, right? Okay, per that contract. Well, here's what we have. Okay, I've now risked $2 on this trade. Okay, I have a stop loss, and I have a Lotto. Okay, My probability of profit is 41%. All right. So in this situation, I'm really risk defined. I don't have to worry about anything else besides losing $192. That's it. That's all I can lose no matter what happens is $192. Okay. But let's say it goes to 170 by then. All right. So I'm collecting all of this right here, just like a lotto would be. But I'm protected because I sold an option to get that dollar. So this dollar right here is free to me for the most part. Okay. I'm sure there's some questions here, so please go ahead.
Yeah, so if you have this whole three-leg setup here, then, which one do you close first? Which one do you leave open? How exactly would you exit all these positions?
Okay, so in this case, you can exit the 170 call whenever you want to. Okay, you can sell that whenever you want to. You could buy that whenever you want to. All right, and here's another thing you can do to it too. This is where we get tricky. I can sell another option into it. Okay, so let's say in a week it moons up and it goes up to 170 or 175. I can now sell an option into that, collect the premium from that, which in most cases will be higher than what I paid for it, guaranteeing me a net profit, right, as the stock comes back down, right? And let's say it comes back down $5, then I can buy that call back. There's so many ways to play it. I'm going to get too complicated. I don't want to do that to you guys yet. We'll do that another one. I'll get in a little bit deeper. But you have to have this right here because you're selling a call. Okay, you're on the hook to give somebody this call at $160. So if the stock goes up to 175, you are obligated to sell this at 160. Okay, if it was down there. So if it came back down to 160, right, you would have to sell that to them. Okay, but you're protected right here by that. So no matter what, your max loss is the difference in premium, right? And $100 per option or per difference right here. So you have a $250 difference right there, minus your premium is what you get for this, plus fees. So that's your stop loss. And we can go back to this, whereas let's say you had the 170 call, right? And if you were to just buy that YOLO or Lotto, you're risking $90 on that option, right? So you're no matter what, you're never getting that back if it doesn't hit 170. If it goes dead, you've lost that money. In this case, if this finishes at 165, you get to collect the premium and you can sell this option into it. So that's one way to do it. How many people did I confuse here?
The only confusing thing is if you had a bullish position, selling the call the only thing that seems weird is you're either bullish or you're not bullish. So it seems weird to buy a call more out of the money than the covered call, or not the covered call, the call you sold.
So, okay, say that again.
Sure. It seems weird that if you think that it's not going to reach 170, which is presumably why we're selling the 160, we are then expecting it to reach 170. If you want it to reach 170, why sell the 160?
So the reason that you're selling the 160, the only purpose of that is to collect premium. Okay. So if you're saying it's bullish in this case, so I'm saying it's super bullish. I'm saying it's going to be at 170 by December. Okay. But I don't want to risk my own money, right? So if I'm saying that it's going to be at 170, why don't I sell a call at 160, protect myself at 157, okay, collect that $93 or $90 so I can then take that and then buy the call, or excuse me, $102 in this case, right? So I'm collecting 102 back on it. So I'm basically doing that as far as trading the 170 risk-free, right? My only risk is if it's lower than 160. Okay, you can see here my break even. So if it's at 159.42 on December 17th, I break even on the trade. All right.
Yeah, no, this is exactly what I was hoping to see. This is incredible. I think I get it. But I'd like to see if you've got another example.
Sure. Why don't you guys give me a stock that you guys have? Somebody give me a stock that you have a trade set up on or anything like that we can do it on.
Yeah.
Is this also the assumption that we hold to expiry?
Yeah, let me cut it.
Is this all under the assumption that we hold this until expiration?
No, you don't have to hold it at all until expiration. No, not at all. So all you have to do, okay, so let's say it goes up to 170, right? And you want to sell it. You can close it out. You can close them all out. The only thing is that you have to close this out before you can close this out. Okay? Because if you close this out, you are now naked on this, and your broker won't let you do that most likely. Okay? You need high level options to be able to sell naked. Okay? So you can close these out, not a problem. You just have to close this one by buying the call back first. So what we would normally do is we would combine these two, and that would be a vertical, and we would do those at the same time, right? We would close these two at the same time. We could leave this one open if we wanted to, right? So somebody give me another example, and we'll do another one real quick.
Yeah, it's a stock over $75. Anybody got anything they've been looking at?
Yeah, somebody give me a trade that you're looking at. It's got to have liquidity, right? So any price. I can do it at any price. It just has to have liquidity. I mean, options you prefer them over like $20, $30 usually, but any of them we can do. Sure, we can do Tesla. Tesla's a good one to do. Give me a price target.
Quickly, sorry, can you just quickly scroll to the bottom? Just look at the chart.
Oh, you want to look at this chart down here?
Yeah.
Sure. This will give you your kind of your analytics. I use the one that's in Thinkorswim for analyzing. I use that one more than this one, but this one will actually give you as well. So in your time frame, it'll tell you how much your option would be worth on which day it would be as well. Okay, what your percentage gains are. So, yep. Nice. Oh, there's questions in there? Hold on, let me pull it up. Oh, okay, hang on, let me go there. Let me pull one up. Somebody pick one to, I'm not in there, hang on. Let me see. All right, let's see. Oh, Tesla, Palantir, SPY. Palantir. SPY is a great one for trading, day trading and stuff like that. I trade SPY and SPX, so.
Yeah, let's see that. And I'm in Thinkorswim, where you like to use the graphics.
Yeah. I use the graph on, which is going to be. I use the graph on iron condors for the most part. Which we'll talk about that very briefly at the very end, and I'll show you why. Okay, but we'll do SPY here real quick. So, give me a price target on SPY. Let's say you want to, a 2-day trade if you want.
Shit.
Okay, I got SPY put spreads and on there. So let's do a SPY put spread for December 17th. Okay. So we'll do this. We'll do December 17th for a SPY put spread. So in this case, so you think it's going to go down, correct? Okay, is what you're saying. And SPY price is at 459 is what current price. Okay, so let's say we think SPY is going to go down. All right, so I want to give it a little bit of room because you're on the hook for the difference here, but you want to collect some premium so that way you can buy a put. Where do we think SPY is going to go down to? As far as is that 459 by December 17th, what's kind of our area, or what is our risk going to be on this? What are we willing to risk? Somebody type that in. 450, first one in. Okay, so we got a 450 total risk on this one. That's a pretty big one if we're going to go out that far. So if we did this, we could do 219. So we can do that. We're going to buy a 460 call. Okay, we're going to come over here and we're going to write a 460, 219, 45. There we go. We got a little one. We're going to write a 455. All right. And then we need the 17th. Oops, sorry. Wrong date. Okay. So we're going to do 155. Oh my gosh, these are way more expensive. We got to start this over. Sorry, guys. All right. So we have 165s at 293. Oh, we're at, sorry, 450s. This gets confusing when you're doing this. I usually use it on Thinkorswim first, so apologize. All right, so 460. All right, so we're at 460 is what our price is, and we think we're going to risk 450. We think, let's say, it can go down to 440 or something like that in that area. So I'm going to buy that call at $8.54 per contract. All right, then I'm actually going to collect a premium by taking a 460 call, and I'm going to sell against that.
It's a change of the date.
Thank you. Appreciate you. When you get in these big ones like this that have liquidity, you have so many options in here. So we have 455 we're looking for. Keep going down, right? Okay, so then we got, here we go. Okay, so we got 1167 and 854. All right. Now, that's the difference in there. So if you take that and you want to do the math on it, 11.67 minus 8.54. So you have $3.13 in premium. Okay. Now we can use that to our advantage by coming over here and buying a put spread. So 313 is what we have. So we're looking for something around 313 area. And you got to go all the way out of the money in here, right, to get some of these. So like if we're down here, then that's got to go a big ways, right?
Yeah,
so
444.
444. Okay, I'll show you another way we could do this. Hold on. Okay, look at that. So now we're risking what? We're risking 878. That's more than we wanted to, right? We have 378 as our entry cost, but we're risking 878. We have a 20% probability, and it needs to get to 440 to break even, right? So it's not probably the better of the two that you can get, so you're really going to have to go out of the money for that risk. So what we would actually probably do in this case is we would probably sell another one into it. And this is where you're going to get into a 4-leg. And I know it sounds complicated, but this is all to do with risk reward, right? That's all this is all about. Predefining your risk and knowing what your reward is. Now, most options guys that do these are going to take profits between 80 and 90%, just to make sure that they're taking their profits, right? But the biggest thing is you're risking, in this case, a predefined amount. It takes the stress out of the trading and everything else like that. So in this case, we go back to the December ones. We did the 460, okay? And, right, we did 460 to start with, and then we wrote a 455, I think.
No, so it seems like you're literally harvesting risk with premium.
Yes, it's exactly what I'm doing. I'm taking premium from, you're saying that it's not going to go any higher than 460, right? Like that's where you're kind of saying it at, and you're saying I'm willing to risk this. Well, in that case, you're just basically taking an option, collecting money from other people by selling it, and then using that to gain where you think it's going to go. It's a directional play, right? Is what this is. So, and we're just trying to predefine our risk. So in this case, we have like that 313 difference that we had up there. Well, these options are pretty expensive on here. So I can come up to here and I'm trying to reduce and maximize gain by doing this. And 450, so we're going to sell a 440 put, right? And then we're going to take that money back. So it's a directional move. Okay. We've now increased our probability, right? Here's our probability. So we're at 44% probable. Now we're actually collecting $87. So by doing this trade, my broker is going to give me $87 in my account also. Okay, my risk is now 413. That's my total risk. That's what we wanted to say. It was 450 basically, and my gain is $1,000. So now I'm saying to you, I'm saying by doing this spread, you have a probability of 44% at a max return of 2.6%. Okay, with a risk predefined, and if nothing happens, if it stays at 455, you break even. You're collecting money up front. So it's costing you nothing to trade this at all.
That's better than the casino.
You are the casino.
Literally.
In a way. I mean, that's when you look at this, when I look at doing options like this and selling premium, okay, you're looking at it from a money market perspective or a market maker perspective, right? The casino has house edges and wins all the time. Now, I know it's complicated and we can get into more details and I can do this again, but I don't want to take up too much time, but I want to go back to one thing that we all talked about, okay? The Lamborghini Huracan, right? Everybody put a price in there, right? Okay, when we go back and we scroll up the price, it was 250 to 400, okay? The example that I can give to you guys, the best way, I just saw Huracan doing donuts picture in there, okay, is what if I was to tell you that you could take a trade and you could define a range of that trade? So the Huracan example, you think it's 250. Somebody else thinks it's 280. Another person thinks it's 300. What is our range on that trade? Our range on buying the Huracan, okay, is between 200 and 400, right? So now we have a range that's been defined. So an iron condor is taking advantage of range and selling premium. A lot of the full-time traders, okay, a lot of people in here probably want to be like, you know what, I want to trade full-time. I want to do this. I want to make gains, okay? Gains is all about managing your risk and reward for a long term. And this is what this allows you to do as far as doing iron condors, covered calls, spreads, and things like that, selling premium. Because now I'm collecting money, okay? An iron condor is just that. We're selling premium on both sides, okay? So if we were to go to an iron condor, which is what I trade on a daily basis, you know, people trade lottos. I do these on the SPX, right? This is something new I've been getting into. So let me show you some of these, okay? Now, this is where you get into the day trades, okay? So in this case,
you show us on Thinkorswim?
I could show you on Thinkorswim in a second here. I can, yep. So I'm going to put it up here. Hold on. I'll come over to Thinkorswim for you. Hang on. November 19th will be Monday. So in this case, I'll be looking for an iron condor on Monday to trade. All right. It's currently trading at 46, 68 or 46. Is that right? Okay. 46, 45.94 was the last one. Okay. Where it traded at. So I'm going to look for a spread that is going to be finished between those numbers on a daily basis and collecting premium. Okay. So at 45.94, let's just say we're going to do 100. We're going to say it's at 46. We're going to look for 100. Okay. So 100-point swing in these cases, you're going to look for delta. A lot of the times you want your total delta to be under, you know, I prefer to be under 40 if you can, but it's all about collecting premium. And sometimes you're not going to be able to find some great spreads that are farther away where you're trying to collect that premium. And in this case, I don't see a lot that we're getting on here. Hang on. $45, $44, and $47. So, okay. So really what you try to define on an iron condor is that I'm going to sell it and I want the ending day price to be between whatever those two field goals are. Okay. I don't care where the price goes, up or down, as long as it finishes in between, because I'm selling calls to collect premium on a daily basis. Now, your risk is actually higher than normal on these trades, but your probability of profit is also higher. So you're usually dabbing in a 70 to 80% probability of profit, but your risk reward might be a 1 to 3. Okay. You understand?
Yeah, absolutely.
Okay. So in that case, you can come over to the buttons over here and you can pick an iron condor just by buying it. All right. And then you're selling it. And this isn't really giving us a lot of spreads that we would do this on in here right now. I don't know why, if it's because the market's closed or whatnot. So we could be over here, but like we would never buy these spreads, and these are so bad that you would never even touch these. I mean, look at the gap difference in these, so they're not right. Let me see if I can find a different one to do it on. Hang on, Apple might have some.
Yeah. Well, so I wanted to ask, like, where are you going to be? I know you mentioned you don't have a lot of time for social media and things. Are you going to be able to participate, hang out, and do future workshops, or?
Yeah, I'll help you guys with some of the workshops and things like this on understanding them. I don't mind doing that. I mean, this is the way, if you want to gain your, increase your overall portfolio, and you have a small portfolio, which is what a lot of people do. Okay. Trading options is your best way to do that, because it defines your risk and it gives you leverage at the same time. Okay. A lot of people that have smaller accounts can't buy 100 shares. And where they get focused at is they get focused on the immediate gains, right? Especially people that come from crypto trading, right? You think, okay, well, you know what? I can buy this crypto asset for $100 and it might go up 30% in a day, right? Well, that's great, but you're not going to get that from these type of plays, right? So what I suggest for newer traders to do is learn your credit spreads and learn how to trade covered calls or iron condors. Okay, covered calls are when you own the shares and you're selling premium. Okay, there's 3 options types that if you learn to do, you can increase your portfolio 15 to 20% in addition to what you currently have. Okay, 15 to 20%, because what you're doing is you're collecting premium all the time. And a great example I'll show you again is on this Apple. The price on Apple on Thinkorswim is at 156. Okay, so if we came over here and we said, you know what, again, by January 22nd, this price right here is going to be below 170. Okay, so I can actually buy this. Okay, we'll click on this and we'll say, well, we're going to do an iron condor on it. Okay. Okay, so we're going to take the 175, all right, which is at $2.03. Okay, we're going to buy that. We can then sell the 170 right there. That's 67 cents. Okay. Okay. Now we come back down to the underside because we need a wing for it. You can do this both ways. You can actually do this after, but I prefer for new people to do it earlier. We're going to say, okay, that delta right there is a 20 delta. Okay. Our probability of profit on this call that's in the money is 16%. Okay. So we're selling one, which is the 70, at 23% probability in the money. So I have a 77% chance that will finish out of the money. Okay, that's a pretty good chance right there by that date. All right, so I can come back down here. I can say, okay, well, I don't think it's going to be below 130, or maybe I don't think it's going to be below there. So I can go ahead and I can add this into it, right, on my put side. So I'm going to say I'm going to sell the 135. Okay, and then we'll have to buy. We want to keep them pretty even, and you can get the dollar increments, but I'm going to buy the 130. Now I'm collecting $1.32. Okay. Now you can do this on a daily time frame on the SPY. I did one just yesterday that had a profit of $2.10 in 1 day contract. It was a little tighter, and I closed it out at 67% before the end of the day. But the example on this one is now I'm collecting 132. We're going to go to the Analyze tab, and I'll show you the chart too. Okay, we're going to analyze this trade. Okay, here's my iron condor. Okay, yeah. If you, a lot of people might not understand these. It's not, you know, they can be a little complicated to see them. But so we'll go in here and we're going to reset these. We're going to say, okay, here's my break-even points right there. So 133 to the low side and 171 to the high side right there is my break-even point. So after that, that's when I start to lose money. If it finishes anywhere in between here, then we're safe. Okay, and I can even go look at this on the chart if I want to. And I can say, there's my range on the chart. Okay. So as long as it's below here and above here, we're good. We're collecting that premium. All right, which in this case is, okay, $132. We're risking $368. All right. So let me show you what the probability on this real quick looks like, and then we'll finish up. Okay. Let me switch screens. I'm almost done. Okay, we're going to go back over here. And we're going to do the iron condor in here. I like to start on the bottom on these because it confuses me. So we're going to do the January 22nd one, and we're going to say 175. I'm going to come over here, 175, right? And we're going to write the 170. Should be the same date, okay? And then we're going to write the 135 here. And we're going to buy this. The reason we're buying the underside is to protect us. Okay, we have to have protection. Otherwise, you're open to huge risks. Okay. Now, see, here's our probability of profit. So we are 67% chance to make profit. Our return on risk is 35%. That's actually pretty good in comparison with these two, right? My max return is my premium. I make nothing more than what I collect on the premium. You're not trading for the upside. You're not trading for the downside. You are trading to have it defined inside that range, right? The example being the Lamborghini. It is easier to guess a range of price than it is to pinpoint a price over a period of time. If you do as far as any research on this, you will find that the most long-term profitable traders use these strategies to collect premium, not to just trade. You have your swing trades, you know, where you have good setups, but then this is how they trade on a daily basis, where they trade the Russell, right? They trade the SPY, the SPX, the most liquid options that you can find. And I'll give you one last example before I go. I'll come over here and we'll do.
When would you exit this, the iron condor?
I wouldn't exit it unless I was collecting profit or if it went one way or the other. So example, let's say it goes back down, all the way back down to right to my break even. So it goes to like 137. I would close out the top end of the trade, right? Buy back the one I sold, okay? Collecting that premium there so I can put that in my pocket and say, thank you very much. Okay, now I'm just on the bottom side, right? And then I can adjust that trade. Let's say it's going to blow through my stop. It's really bearish looking. I can close out that side, or I can buy a put underneath of it in case it goes lower to protect me there from any downside risk. A lot of traders, what they'll tell you is an example being, if you're doing iron condors or trades like this, and you know you have 5 trades, like you know the bigger traders, what they'll do is they'll do more than one contract, right? Where I might do 5 contracts, okay? So if I'm a 5 contracts on here, I need to have one downside risk, 5-to-1 risk, because what happens when the market tanks, right? Usually your massive moves are to the downside, not to the upside, right? Your black swan events are to the downside. So if I have 5 contracts on this iron condor that are over 30 days and I want to protect myself, I would buy a Lotto put, right, to the downside. I would take 3 to 5% of what my profit would be. So in this case, if my profit's $132 times 5, I would take that and I would buy a put to the downside in case of a black swan event came running through. That would protect my entire trade, right? The premium on that, I could sell that or collect that later. So that's one way to protect yourself to the downside as well. So kind of complicated stuff, but after you start seeing the benefits of how to use options where you can adjust your trade in any situation, then you're going to become a better trader without a doubt, right? I do a lot of trades, and I do a lot of these trades which are collecting premium the entire time that help me pay for my other trades and help me define my risks and so on. These are best done on a daily basis that I find on SPX, where I can do them, like Monday, Wednesday, Friday. You can do them overnights. You can do them on a longer term time frame. I trade Tesla on this. I don't trade Tesla with, calls or puts. I trade an iron condor on Tesla because I'm more interested in knowing where Tesla is going to be range bound and collecting that premium instead of the volatility that comes with just calls. So the best thing about iron condors is that you're trying to buy them when you have high volatility or high implied volatility because you're collecting premium off of that. Iron condors are for when you want volatility to go down, okay? So something like a Tesla, which is high volatility, I want the volatility to go down, and I'm collecting the premium off of that. Did I put you all to sleep? Everybody still here?
So,
not at all.
The trade doesn't go your way. What exactly happens then? I feel like everything would be going up, some would be going down. You'd be kind of in a world of confusion. I mean, for someone who hasn't really done this.
Well, it's going to go up and down, right? I mean, so like I said, like when we look at this, right, you go back to it and we go to the analyze, and then you look at it on the chart, right? So again, it's going to go up, it's going to go down. So ideally what you want to do is you want to put it at an area. Like this is an area of resistance right here, right? It's been resistance and support prior. It hasn't been tested, but it was. So that's an area that you'd want to put it at. So, if it's going to come down to this area, that's fine. I don't mind. I don't mind if it's anywhere in here, as long as by the end of the date that it's not above or below it. Okay. If it gets to, let's say it gets down to here, I might sell the top side to make sure I collect that profit, right? Or if I really want to, if I think it's going to keep going down, I could get out of the bottom side down here of the condor, right? I could close that out because I think it might go down and leave this side open and collect my max profit off of this. And then I could adjust it and say, oh, let me open up another one right down here because I don't think it's going to go below there and collect more premium, right? When you come over to the options, I know that you guys all see this when you guys look at options because it's one of those things where you're like, why is there 58,000 open interest options at 250 on Apple? Who is buying options at 250, right? Who's buying that? You see these, right? Like you have to look at that and be like, wow, how is there that much? Because people are playing the premiums on these. This is when they're on the outside of the wings. You can come back up and you can look at the put sides too. And I bet you that there's, some of the same over here, 110 open interest, right? They're collecting premiums off of these. So that's the whole point of an iron condor is you're looking for stocks that have those. And the best way to do that is you can come into your watch list and you actually have on Thinkorswim, you actually have one that is designed just for this. And it's under penny increment options. All right. So if you come over and you scan and any of these, I actually just usually go to a watch list and it's in there. I don't think I have it on this one, but let's see if we can pull it up. It should be in here. I know. So basically what the penny increment options are is that the spreads are within pennies, not dollars or anything like that. So you usually will find the most liquid, which is the the highest volume assets, the Teslas, the Facebooks, the FANG stocks, right? The ETFs, the Qs, IWMs, the Russells, the SPYs, the SPXs. That's where a lot of day traders will trade these and sell you their options for the premium. And that's what their goal is. They're not in it for the stock to go up to make money or to go down. They're just in it to collect the premium off of the volatility. The higher the volatility, the higher the premium is going to be because your implied moves are higher. And that's where you're going to look at, and you want the volatility to fall. You want to do iron condors on a daily basis, then, there's plenty of ways to do that. You can do them on a longer time scale basis too as well. You're just trying to collect premium the entire time. So.
All right. Is that it for your segment?
Yeah. We can swing back. Feel free to ask me questions later. I know it's complicated.
No, that was awesome.
To you guys. So.
Really, really appreciate it. Does anybody have any questions for 5150? All right. Yeah, that was awesome. Thank you. Go ahead.
So I started trading options probably a year or two ago. I traded Lottos, and then I was in Mitch Ray TA, and I met a guy named Jeff Probst. And Jeff Probst started to teach me how to do credit spreads. And then I started learning how to do condors and vertical debit spreads and so on, and playing around with it. And I paper trade. And my suggestion to everybody in here is you should be paper trading all the time. Okay. As any asset that you see, every trade that Champ puts out, if it's not your style or whatever, you don't want to trade it on your own personal money, trade it on paper, play with it, learn it, right? And do options on it, all of them. So that way you can get a feel for it, right? If you're familiar with Crown, the guy that Jeff and Crown learned from the same guy for options. So, we have our own Discord that there's some high level options people in there that we discuss our option strategies and so on and so forth. But if you want to gain knowledge and grow your book on a smaller time scale, it takes longer, then you should be utilizing these types of options plays for your benefit.
Absolutely. Any other questions? All right. Well, thank you very much, 5150.
Yeah,
that was
no worries.
Awesome, man. So now, let me go back to the screenshot. Now we're going to have NeutronFluxLabs talking about orders and scripts and whatever else he wants to for 30 minutes or 20 minutes. I'm sure it'll go up to 30. And then after that, we're going to have Mehdi and TheLump finish everything with their new scanner system. So, yeah, Neutron, you want to go ahead?
Oh man, this is hard to follow up. I'm getting put in a bad spot here after these guys. It's hard act to follow. This is high value stuff, guys. Really super duper important education you're catching here. But I'll just cut to it. What I wanted to add, I've made some fantastic notes from 5150, Keanu, and Champ. And I'll just make some real quick additions and then get into what I talk about when I say a spread on an option or on a Lotto context. It's the gap between the bid and the ask. And you're going to want to buy an option. So you got to get filled. And you get filled one of two ways. But we'll get to that real shortly. So when you're looking at these charts, pay attention to your wicks. That volume, that's the confirmation you need. What everybody said really is the truth. So check into volume price analysis. It's a book by Anna Cooling. Let me look at my notes here. Yeah, and I might throw 5 to 30 minute opening ranges and opening range higher lows, since nobody's kind of mentioned that, and that's important when you're in a Lotto. So let's just get to it. Let me share my screen, and we'll talk about. I don't really have anything fancy or a slide deck for entries. So we'll pull something up and show you a spread strip.
Neutron.
Yeah.
Sorry to cut you off. I don't know if anybody touched on it before. I'm going to be getting to you when somebody did, but Sunny Money shared a chat in the workshop chat.
Get over here.
I just want to make sure we include that because he messaged me as well.
Sunny, before jumping to options, what's your brokerage? Supports, calls in the money, risk. Is that the one?
Yes. Just your thoughts on it. Or touching
Yeah.
on it.
Absolutely. Yeah, I would like to talk about that. So as part of the whole entry thing goes is your fills could be terrible if you're on Webull or if you're doing limits and the stock is moving too fast. With options trading, you're either doing complex risk premium harvesting or a risk managed option trade like 5150 went over, or you're doing a lotto. And oftentimes you're playing a lotto based on technicals that you expect to move right now, or you're doing it based on news. And if you do those things, you're going to have your implied volatility and your volume spike, and that thing's going to move. And you will find on Webull that you can't market, sell, or buy at certain times at all. They will literally give you an error message and say you can't do that. So you must, if you want to get out, I think Keanu say market out was the word, and I wrote that down because that's a term you may not be familiar with. You've got the market buys and sells, and you've got the limit buys and sells. And so if that thing is moving, you may have to increase your limit order price. And if you do that and you've got a large spread between your bid and your ask price, you're going to end up not making as much money, or you may buy that option at a higher price and you may be upside down from the start. And that's where the significance, and if I can get my computer to work here, obviously some problems. Screen share. I want to share with you. There we go. Thank you, computer. All right. So I want to share with you a practice that if you do want to trade lottos, naked options, intraday, it helps. I mean, Thinkorswim, it's a different layout. It's a little complicated to get used to. But there's a lot of power within it. And even if you don't want to trade on Thinkorswim, you can go get the software and you can check options prices like 5150 was showing you. You can, use the chart, analyze, and scan. It's a great tool to have, regardless if you want to use it as your broker. So what I have done to help me in my lotto trading, regardless if before I've selected the option to trade based on the TA or even the news, I want to know that my spreads are less than 10% between the bid and ask. And both Keanu Champ and 5150 have said, oh, well, this is horrible spread. Well, how do you know that? 10%, 5% is a good range to be in, depending on how tight, how liquid you are wanting to trade these options. So as a practice, when I go in and play lotto options, I want to get in fast if the move is already happening. So you may market order is the way to go if you get filled properly. If you're on Webull, like I mentioned, you may not even have that option. So you're going to have to do a limit order, and you're going to have to increase that limit price, and you're going to have to pay more just to get in. But if it's on news and it's moving, mind your risk. But one of those ways that I manage my risk is I want to look at the first. So let's knock this down to 6. I want to look at 6 strikes, and we'll just minimize all these other guys here. So I'm looking at Tesla. Obviously, the market's closed right now. But the strike price is around 1080. It traded 1081, 92. 1085 is the next one displayed, 1090, so on. So I want to cast my eyes on this. And if I'm trading a Lotto, I want my volume and my open interest to be significant. I want liquidity to get in and out. And so I always look for options that are over 500 in volume, all right, and over 1,000 in open interest. So this guy at 175, that's not very attractive. I meet my volume over here at 531, but these numbers are probably screwy because the market's closed. But the sauce is in this spread. I have added a column with a script, a little bit of code, and I'm going to post it out here in the channel's chat that you can add in to your layout. So if you click layout and Thinkorswim on your options under trade, you go to customize, you can hit custom. You'll get a new window and you want to go to Think Script Editor. And I'll just dump this in here. But this is basically going to say, take the bid and ask, and let's do some math. And if it's less than or equal to 10, then that's okay. Green. Show me that that is an option I could yeet YOLO Lotto into, and I may get filled at a reasonable number if the trade keeps moving my way. If it's outside of that, you don't want to touch it. You're not going to get a good fill. It's going to be bad. There's not enough liquidity. So I'm going to drop this code over here into the chat.
Thank you.
And you can include this in your Thinkorswim client. I love OneNote. It wants to do everything as a picture. All right. Perfect. All right. And so if you apply that, now I've got two. What you end up with is a view where as you go to trade your lottos, your options, your naked options on a lotto, a news mover, something like that, you can see at a real-time glance. And again, this is going to be updating very quickly during trading hours. So I've had to expand out into January 22nd, 2022 options to see something that's got a larger spread. So if you were to try to get into something like this that's in red, you would be very upset. But I didn't have anything quite as formal as the rest of our excellent presenters. But when it comes down to entries and exits, the reality is you've got to be focused on these spreads between bid and ask. These are the sellers and the buyers. And depends on your broker where you're going to get filled. And it depends on your order and how fast the stock is moving. And just as a tool that I have benefited greatly from is being able to see on the screen of my broker that percentage of the spread between the bid and the. And then I'll just cover opening range high and low real quick because it is about lottos and getting in and getting out and something that's kind of been tested a few times. And I've got TradingView pulled up. I don't know how many people back test things in their charting applications, whether that's the on demand or the let's see here. TradingView has got their, or I'm sorry, analyze. Think back is what it's called in Thinkorswim, but TradingView has got a fantastic tool to go back in time and walk things back. And I encourage everybody to do this. Like 5150 said, if you're not comfortable with the trade, paper trade it. If you're not comfortable with how you did in a trade, walk it back in TradingView. Go back in time. So let me change my screen over to that, and I'll show you the opening range, high or low, and then I'll cut back over to Mehdi and TheLump, the clown gang, because I want to hear about Bollinger bands and all kinds of fun things like that. Let me see here. I think I've got TradingView up. Do we got TradingView up, guys?
Yes.
Any questions so before I jump onto this? I know I went quick, and if anybody wants to DM me about the spread percentage script, just let me know. All right. So this is SPY. We backed up to the 22nd. All right. We've got, we'll just kind of look back here. When you say opening range, I use shorthand RL, ORH. So that's opening range, high and low. And typically you want to look at the price action within the first 5. Some people do it in the first 5 minutes, but it's more common in the first 30 minutes of price action trading. For any, going to go with SPY. And so we open up, we bounce around, and you see we are pretty much captive within this 30-minute opening range of price action. And we come up, and I'll try and zoom in here. This is my normal terminal. So we come up, and like Keanu said, we're going to back test. And we back tested, and we made a run. And then we came down and we tested again. And we didn't quite. Oh, but wait, we actually formed a harmonic as we re-entered the channel. We tested the hop of that harmonic. We went and did target 1. We came back down, tested again, made a Gartley. That's the end of the trading day. I've got extended hours on. A lot of people don't trade with extended hours on, and they don't chart. I don't suggest you change what you're doing. I suggest you just take a look at the dark side, because even though there's less volume and volition there are traders. I mean, there are price action. You may not have liquidity to get in and out. But anyways, we made a high. We've charted a green line with this indicator. We can go in extended hours. Here we are back, market open, 1 minute time frame, back on the 22nd. And we're just going to hit the play button. This is a great feature in TradingView. Don't sleep on Mr. Not the alert guy, but the bar replay. So we're going to crank this up in the interest of time. We're running over here. We want to see Lump and Mehdi. So here we go. We immediately made a nice range at open. And we came back. We sort of tested that area. And we re-entered. Kind of thought about a harmonic. And so these ranges you'll see get respected oftentimes. You'll trade within them. When people talk about a flat day, you ended up maintaining the range. You see here, just walking it back, we made a bearish ABCD, and we're kind of trapped here. I've got this other green bar. That's a 50% retrace for the last 200 bars, and that comes from Ikimoku. But anyways, that was the end of the day. We pretty much stayed inside the range. But what is still existing is the lows from the day before. So I encourage you, if you don't want to get an indicator for opening ranges, mark those first 30 minutes out. And those will almost foretell the future as far as support and resistances. There's something kind of magical about it. And obviously, this is never financial advice unless it was crypto, which is unregulated and the rules don't apply there. Anyways, that's really all I had. Any questions about the script or entries, exits, getting in and out of options quickly in a hurry, or opening ranges, or anything in general?
Anybody?
Yeah, can you repeat what you said, that last key point about the 30 minutes open?
Yeah, so I'll just pause it here. And so I've got an indicator on here that not only shows me the 30-minute range and moves it to the right, but it will show me the prior days ranges as long as they are not broken. So you see here on SPY at the close of the 22nd, we actually traded down here. And so that line's going to move forward into the next day, and that's going to show me the prior day's low. And so if I were to jump ahead here, I can come back in time and find where prior day's lows of the trading ranges that were not broken will then be future support or resistance. And so like here, I don't know what's going, my charting mode's all screwy. So we can see, where'd it go? You'll have to excuse me. I'm on my cruddy computer. I'm moving computers around. So we've made this low down here. We've broken below the range. That is the lowest point. It wasn't the opening range, but the low of the prior day will act as support and resist. I mean, it's very typical, except this is just kind of an automated way of bringing it forward day after day. And that's an indicator I could probably get the code out into the chat for.
Yeah, that'd be really useful. Appreciate that if you could.
Absolutely, it very much helps when you're scalping on lower time frames intraday. You know what goes up must come down and so forth. So.
And Neutron, one last thing before Mehdi and Lump talk. You want to? I don't know if you already did, but do you want to touch on IV Crush just to explain it?
Right. Yeah. So let's talk about that in the context of one of the things I've kind of pounded the table on in the premium chat. A lot of times people will get excited about earnings, and they want to trade options on earnings. And to me, if you do the math on that, and I don't have a fancy website to pull up, it's pretty common sense. Is if you look at the value of an options, a naked option, you'll look across the line and say, well, what makes the premium up? What is the premium? If you were to bake a cake, what ingredients is the premium? And it's your Greeks. And so one of those is your implied volatility. So if it's Tuesday, 10 minutes before market close, and they're going to release earnings after hours, and you think they're going to have a out of the park hit with earnings, and you see an option is cheap and it's $2 out of the money. So you got to be right in a couple of ways, because you've got to assume that company's going to actually hit earnings and the direction, and that's going to move the stock the way you think it will, because they're going to have a call where they're going to talk about things on the call, and they may say something the wrong way, and then the traders are going to do the exact opposite thing, or earnings was already priced in, because most of the time everything's priced in. And so the stock has got to make a massive, significant move in your favor because of implied volatility crush. The premium, the price you're paying for that option, and like 5150 said, he's making money, he's profiting on selling risk. You're buying that option from somebody, he's taking the risk. And so the event's over by the time the market opens Wednesday morning, but you bought the option at close. The option is now worth less because everybody priced in the volatility of the earnings coming out. So you can get IV crushed on earnings, news reports, many kinds of things. And as well as, you start to come up to expiration. And that brings up one of the other notes I didn't comment on. Friday lottos. If you've got a small time frame move and you're entering into that options, you want to have that play move within 1 hour, or then you're going to start having, and this is 0 days to expiration. This is same day expiration, a lotto by definition. You want to have that make that move within 1 hour, or otherwise the Greeks are working against you and you pretty much need to be checking your technicals again or moving on to something else. But yeah, like Keanu said, SPY is fantastic. 5150 said the same. SPY, QQQ, they're all excellent. IWM, they're very liquid for playing options. And always use them in context as your guide. They confirm your TA. Pay attention to your wicks. Check out volume price analysis. I will drop that code for the 30-minute opening range indicator. And just another little thing I was playing with here recently. Just kind of a curiosity thing I suggest everybody kind of play with, and maybe hit me in the chat. But there's this neat feature. If you're using TradingView, you got a plus sign, right? And so you know that there are various stocks that are members of a ETF or a fund or an index, right? So just add a plus sign, add them there, and then add that QQQ. So in this example, we've got Microsoft, Amazon, Tesla, Nvidia, Google, and Facebook, and Adobe, all members of the QQQ. Here on a 30-minute chart with extended hours. And then I have actually taken and added with the compare button QQQ itself. And so what I'm looking for here on this is I want to see these guys, which are the largest percentage of QQQ, whenever they start to diverge and move away, I know they're going to make a pretty big move, but they will return to mean. And so you can see that over time, and it's fun. And there's all kinds of funny things you can do with charts and indicators and harmonics and stuff.
That's actually awesome. I didn't even know about that.
Yeah, so use that plus sign there. And so what's really neat for me is I can take composite members of either SPY or QQQ. And so you add your top 5 percentage members of that fund that are the largest percentage of it that they own. And I add them, and then I actually can see harmonics. And so if you look, our orange line here is the QQQ. This is a 30-minute chart with extended hours. So again, you see the stocks. And so this made a massive harmonic, came down, completed, and within 2 trading days, hit the target one, the type 1 move of that harmonic. And then the next day, this was our short trading day on Friday, tanked and tested the hot textbook.
That's actually crazy.
Yeah, I actually discovered this late Friday. So
yeah, I mean, also for just like sectors, like if you wanted to add together a bunch of EV stocks or a bunch of chip stocks and then compare them to their similar ETFs.
Exactly, in the sector.
Yeah.
Oil, freighters, everything.
Yep.
You can pretty much go down your watch list and then add them together. So that's incredible. I think this is going to be really, really powerful as we all work together and do TA moving forward in the future. So
yeah, and Neutron, you have access to the watchlist scanner channel. I think you should message in the scripts and the indicator and the codes there, and then pin it there so it could be there like for good.
Yeah, absolutely.
Perfect. So yeah, you should be able to pin it yourself. If you can't, just let me know.
Yeah, I'll do that.
Thank you. Anything else you have?
No, that's it for me, unless we've got any questions from this fantastic audience here.
Any final questions for Neutron, anybody?
Sonny asked a question. It's in the chat though. Neutron.
All right, let's see.
I
here.
think that should touch on it. The watchlist scanner. You see his last message.
Yeah, my indicators, right. Gosh, we could take a lot of time just talking about that. we'll make it nice and short because I think Lump and Mehdi's got a lot of value, and I intend to talk about indicators and share some code overall. Yeah, right. You really did open the can of worms there. So it really depends on your time frame, what indicators I use. I'm a big harmonics fan any way you slice it. Early on, I drew them, I understood them, and then I just went and bought what our dear Lord and Savior Scott Carney came up with and holds the trademarks to is his HPC, his harmonic pattern collection. Those indicators are fantastic. I'm not affiliated, and that's about all I'll say. Go check it out. He's got plenty of content. Champ, Mitch Ray, everybody can vouch for him. But outside of that, I do use the opening range. I do use Bollinger bands. Scott Carney's indicator is very similar to Bollinger bands. I am a big fan of charting on RSI. Except you don't see RSI on my charts because, again, I've got Scott's indicator, and he's basically got an amplified version of RSI, but it works the same way. It just exaggerates moves. And what I look for when I chart RSI is, so I'm looking for W and M formations like you would see with a harmonic, but an overbought and oversold regions. So I'm looking for things like that down here that would indicate we're going to have a reaction in that zone. So in other indicators, I am a fan of the Ichimoku cloud. And that's, you basically want to see price action in a lagging span exit the cloud at the same time. And I can just give you a real brief 2-second thing on that. And Ichimoku is built in. It's not complicated. You don't have to pay anything for it. I turned some of the stuff off. All right, so we see price. Go to 3 minute. So we see here 26 price tanks through the cloud. Our momentum span, our lagging Chi-Cow span has never re-entered the cloud. This thing is bullish as it can be. We went and tested the 50%. That's the flat lines in the middle of the cloud. And momentum, everything is bullish, and we kept trading down. And I know that's really kind of a poor example, but what is significant about Ichimoku clouds is 50% retraces overall. And I have another indicator, which is just retracement levels, which all it does is draw dots for the last 200 bars. What's the 50% Fibonacci, the 50% of that? And it just charts it for it. And yeah, that's kind of what I use. So.
All right. So all good?
Yeah. And I just wanted to say I love you, Lump.
Good stuff there. All right. Thank you, Neutron. That was amazing as well. Now we are going to have our final segment, which is going to be Mehdi and Lump. So I'm going to pass it over. Mehdi, if you're ready, feel free to start going. Yeah.
I'm going to share my screen. Can you guys see my screen?
Yep.
Okay. All right, so pretty much for this, we're using mostly the Bollinger Bands. It's pretty easy to use. I'm just gonna go kind of cover it for the basics. You have the bottom Bollinger Band. That's pretty much, you could see your support. You have your top of the Bollinger Band. That would be the upper Bollinger Band. That would be kind of more of your resistance. And then the middle one right here, we use that as a break or make area. So I'll show you guys some examples. Right here, you had it as a nice support. Right here, it was a nice support. And then if you look at resistances right here, here, and here. So same thing with this chart. Top would be resistance. Right here is support, support, support. And as you see right now, like right here was also another resistance. And as you could see, this yellow line, the orange line is like a break or make area. If the stock or the price action can't break this, it's most likely going to come back down to the lower band. If it could break, then if it retests, then it most likely would be able to hit the top of the Bollinger Band. That's pretty much what we trade. And in regards to the chart, what I look for is I always start off by putting on the SPY chart, VIX, and then the QQQ, so I get an understanding on the lower time frame. I usually use the 5-minute, so I understand what is going to be going on in the market. So what I do is, can you guys see like my watch list on the side?
Yep.
Yeah, okay. So what I do is I'll have a bunch of large cap stocks that are pretty liquid, like Apple, Microsoft, Tesla, Netflix, etc. And I would keep an eye out on all these. But before I even consider trading these, I have to look at the market in the short term. So what I do is I'll look at the SPY and I'll look at it. If I see it's at the lower band right here, so you can see right here it's at the lower band, but at the same time the VIX is at the upper band. My apologies. It's at the upper band, and at the same time the VIX is at a lower band. And if you see, the QQQ is also at an upper band. So right there, that tells me that if I have 3 charts that are looking at the overall market, that tells me that the stock is like the chart and the market is going to start coming back down, because you have the QQQ and the SPY hitting the upper and you have the VIX hitting the lower. So at that point, what I would do is I would go ahead and visit my watch list, or in this case, we have the scanner. One sec. So I would start going through these watch lists and trying to find the stocks that are at the upper bands, because we know that the market, the VIX is going to start coming up, and we know that the markets are going to start coming down. So I'm going to look at all these large cap and try to find the ones that are at upper bands. And not only are they at the upper bands, but they have some sort of either divergence, harmonics, maybe rejecting the VWAP. You have to find as much TA as possible in a chart before you take it. So I'll show you some examples. In regards to here, these are going to be all charts that I'm showing you guys that I've taken positions on. So this one right here, we have the SPY. It reached a very strong area of support, and it got out of the lower Bollinger Band right here, right here. So what I do is I'll look at the 3-minute and the 1-minute. So if this is outside of the Bollinger Band, I look at the 3-minute and the 1-minute, and I want the 3 and 1-minute to start coming back up. So what's going to happen is, if the on the 3-minute and 1-minute, the stock's going to start coming inside the Bollinger Band, but on the 5-minute, it's still going to be outside. So that's what's going to let me take a position right here rather than entering right here, where I'm going to have more risk to the downside. Because at this point, we know that we have like a strong support at 451 intraday support. So I know that if I have to cut my losses, I'm cutting my losses at a very small percentage. Where if I'm playing at the upside, I have a huge reward. So the risk and reward is going to be more than like 3, because the loss is very small and then the win is very big. So what I would do is I would take a position right here. Once I see the 1-minute and the 3-minute start coming back in, so to get an entry about right here, start playing it up all the way until it hits the middle band. Once it hits the middle band, at that point, you could either take your profits if you like the profits. Or what you could do is you could keep an eye out on the middle band. Does it break the middle band, or does it reject? If it rejects, you would get out, and what would most likely happen is it would start coming back down here. And it may retest for a double bottom, and you could enter in it again. And you could do these type of trades, like you could take probably 10 trades a day if the market's showing. Typically, I would take about like 2 to 3. But this is what I would pretty much do. So in this case, it broke the middle band and it kept going, and as you can see, you had nice volume and it kept going, and what happened, it touched the top of the band, and at that point you'd cut your profits. You take your profits, and what happened is it came back down and it started playing sideways. It touched the middle band, but in this case, you don't really have any other technicals that you could look at. So taking a trade here isn't really ideal. But what happened here is it kept going up, and then it broke above the upper band. So as you can see, it's well above the upper band, which is right here. At this point, you would look for a possible entry, but you have to look, is there any divergence? Is there harmonics? What is there? So right here, you do see that there's bearish divergence if you don't ignore this. And even if you do ignore this, then you would still have bearish divergence using these islands and these islands. So at that point, you could take a short position. And as you can see right here, this was a resistance in the past. So anyways, I took a position right here, and then it came down. You could either take profits, like I said, at the middle band, and I believe this trade, it came all the way down to here, and then I took profits here. But I'll show you some more examples. So this one right here, you do have a harmonic, you have a bearish bat, and it's outside the upper band on the 5 minutes. So what do you do again? You go to the 3 minute and the 1 minute, and you want it to start playing out on the 1 minute and 3 minutes before you take a position, because it could still keep going up and up and up. But you'd want to use the 1 minute and 3 minutes as a confirmation before entering. So on the 1 minute and 3 minute, it's going to start coming back down. But you'd enter right here on the 5 minute. So what happens is right here, it comes down to the middle band. You could go ahead and take your profits, or you could, like I said, you could wait until you see whether it bounces up on the middle band or it keeps coming. In this case, it kept coming. I didn't play this one. I played this one right here. So for this one, you had an intraday support. So as you can see, there was a support right here. There was more of a support, but the picture isn't really showing it. But as you can see, it came fully down. It came outside of the band completely. And on the 3 minute and 1 minute, it started already running. So what you do is you take a position, and you could also see it's oversold on the RSI. I don't think there was divergence. I don't remember what other things I saw on this chart, but you would also have to pay attention to the VIX. And I think the VIX was at the upper band at the time of this screenshot. So you have the VIX, you have your Bollinger Bands, you have it being oversold, and you have it at a support. So you have multiple factors that you could play, and you could take a position right here. So you take a position somewhere around here, and it starts playing out, and it gets near the middle band, and it rejects. So at that point, you could take a small profit, probably a little scalp, or you could hold it considering that this is a very strong support and you had an engulfing candle. So if you decided to hold, it would come back down, it would retest that same middle band, and in this case, it broke the band. So at that point, you would keep playing it. And remember, this move right here is going to be in terms of options, you're probably looking at 40, 50, depending on what strike price you pick, etc., and the time. But this would be probably a huge amount in terms of profits. So at any point, you could take your profits. In this case, it didn't hit the upper band. And you start seeing that the MACD starts waning back down, and you'd also start forming bearish divergence. So at that point, you start seeing some bearish technicals, and you could possibly get out. And even if you were to get out at the middle band, look, you'd still be in profit because you got an entry well below here by looking at the 1 minute and 3 minutes. A lot of the times I would see something on the 5 minute. If you don't look at the 3 minute and 1 minute charts, you're going to end up possibly getting a worse entry. It might still play out, but you're not going to get the best entry possible if you're not staring at the 1 minute and the 3 minute. And what you're going to look at is on the 1 minute and 3 minute that the bands, that it starts going into the bands and the MACD starts reversing into green before you take a position. But in this case right here, so it hits the middle band, it came back down. And again, we have the same scenario where it's outside, and then you could possibly take an entry. But what I want to show you guys here is, look, if you look at the band, look how wide these bands are. If you decided to take an entry and then it retested the middle band and now it's kind of forming a nice support, but you'd look at the bands and it's getting really it's getting really small. So if you decided to hold this overnight, you know that you're going to have a move either huge to the upside or huge to the downside. But what you want to do is you want to look at possible TAs that you could look for. So like I said, harmonics, support, divergence, being overbought or oversold, etc. And this would kind of give you an idea of whether you should hold overnight for the big move up or the big move down. In this case, yeah,
sorry
go
to
ahead.
cut you off. 5150, are you still here? I don't know if he's AFK.
Yeah, he should be around.
Give him a second. All right, so basically, he was talking about the iron condors earlier and betting on a volatility decrease, if I'm not mistaken. So I was wondering, I don't know if anybody else knows the answer here, but what you could use to profit off of a volatility increase in either direction. If anybody knows that.
Condor.
What were you saying?
Could do the inverse iron condor. But for all of these, I highly recommend. I'll link the site again. It's called Option Strats, and you can visualize all of this. And my favorite part is when you change the IV slider, you can see how you get crushed, or the opposite, how you profit from the IV.
Yeah. So it's called a reverse iron condor.
Yep. I'll link the site with.
Or it's just pretty much the opposite of how you play that.
Yeah.
Because I think that would be a good point. You know, for all of you to look into what Mehdi's talking about right now. But yeah, Mehdi, sorry for cutting you off. I just didn't know 5150 was here. Keep going.
But yeah, so like in this case, you'd probably be able to use his strategy to kind of profit more on this. But in my situation, I'm not aware of iron condor, and I'm not really good in that type of stuff. So I wouldn't have held overnight. But I guess if you were to know multiple strategies, you could implement Bollinger Bands and implement other things to take advantage of. But anyway, so it ran up, and then right here, same thing. You have divergence right here on the MACD. You're at a support, so right here, like if you look, you're at a area where it typically bounces, and it's below the Bollinger Band again. So at that point, you'd look at the 1 minute, 3 minute. Once it starts moving up, like I said, it would be inside the Bollinger Bands on the smaller time frames, but on the 5 minute and 10 minute, it's still going to be out. So your entry is going to be somewhere here rather than entering somewhere here. So your risk is very small, where your reward is a lot bigger. So I took a position right here. It ran up, hit the middle band, and I waited. I saw that it was breaking the middle band, and then I kept holding, trying to get, you know, the upper band. But what happened is it came back down, and then I just cut my profits right here. So I took my profits right here. Could have made more if I cut earlier, but you can't really predict that you're going to have a huge fall like that. So took profits right here. But because we've entered all the way down here, you're still going to make like a good 20, 30% depending on what options you've taken. So that's one example. Let me see. So what we could do, you could also do what Champ always does with patterns and stuff like that. So in this case, on a 3 minute, you had a nice pattern. As you can see, you have 1 touch, 2 touch, 3 touch. And as you can see, the touches are also with the Bollinger Bands. So you have a touch right here at the lower Bollinger Band, touch right here at the upper with the pattern. So the pattern and the Bollinger Bands are both syncing together. And then it came down here. So for the entry, if you see right here on the RSI, you do have divergence. If you decided to take a position right here, you could run it. But where I took a position would have been right here. So I took a position right here, and I doubled down right here as well. So you had the lower Bollinger Band broke out, took a position with the RSI divergence, played out to the middle band. I knew that it wasn't going to break because the VIX was going against me. So I took my profits right here. It came down for a double bottom with it going outside the Bollinger Band. Took another position right here, and then you have double divergence on the RSI, and then this ended up playing up all the way to the top of the pattern. So right here, this move would have been like a good, maybe like 20%, and then this move would have been like another 40, 50%. So like altogether, you're like making like 70, 80% just by playing these patterns. This one was me and TheLump who played this one. We had bearish divergence, you were oversold, you were outside the Bollinger Band, and then the VIX was starting to go back up, and the SPY and QQQ were at the upper band. So those were all signs that the market was gonna, come down short term for the 5 minute, especially for NVIDIA. So it took a position right here. It kind of played sideways, and then once the bearish divergence confirmed, you had a huge drop, hit the middle band, like I said, you could take profits at the middle band, or you could wait a little bit. You might not make as much money if it doesn't confirm the breakdown, but if it does confirm, you're going to make a lot more. So if you see what happened, it just kept coming down, and I think it went even down further. But I took my profits here. I think this was like a, I don't even remember the move, maybe like a 70-80% move in like 30 minutes or so. But like you said, this happens all the time. You're gonna have a Gartley moves up. This is the perfect example, is when it breaks the band, it retests the middle band, and then when on that retest, it keeps going. These type of moves are going to be the moves that you get like over 100% moves. So yeah, it's pretty simple. And then all you have to do pretty much is, hold on, always have this set up. 3 screens. You have your SPY, you have your VIX in the middle, you have your QQQ, and keep an eye on all these 3. When it looks bearish, go to the large caps and find the ones that are looking bearish. If it looks bullish and the VIX looks bearish, go to the large caps and try to find the ones that would match the overall market for the next like 5 on the 5-minute chart. And keep doing that, rinse and repeat. I honestly don't think, I personally have been 100%, I have 100% success rate doing this. However, when I did not follow my rules, that's where I kind of took my losses. But in terms of actually following the rules, like clear and cut with nice position sizing, I'm literally 100%. And I think the lump as well is. I'm not sure if the lump's still at 100%, but yeah, that's pretty much it. If the lump, you want to talk about your scanner?
Okay. I wanted to know first, like, what do you do when the indices are in the middle, when it's neutral? How do you play around that?
Okay, so let's say the indices are, if the indices are in the middle, you might not want to take a position, because then your chances of being correct is going to be a lot smaller. However, if it's playing sideways, like let's say it's playing on the middle band and it's at the top of the middle band, then you could still, if you do find other like really, really good looking charts on the large caps for bull side, and it's staying above the middle band, then sure, I'd be able to play it if the chart looks really, really good. Same thing with the other way. If it's playing sideways, but it's playing at the bottom of the middle band, then I would look for really, really good bearish charts. But you're gonna have to find like a really amazing chart with like 3+ TAs or technicals before I would take a position, if you want to really follow the rules and get the highest percentage chance of being correct. What I would also do for SPY, like if I want to trade the SPY example, I would also look at Apple, because I know Apple is it has a big percentage in terms of the SPY. If I see that Apple's looking bullish and maybe it's at the middle band and I want to take a position on the SPY, then I would look at Apple. If Apple looks bullish, then I would go ahead and possibly take a position on SPY, and I've had good success doing that. You just got to find if you're looking at ETFs, you just got to find the stocks that are the bigger percentage of that ETF. So if it might be Apple, Microsoft, etc., if they all look bullish, then you could go ahead and take a position on SPY if that's what you're looking to do. But that's pretty much it.
That was awesome. So I mean, a lot of you heard that. I mean, he said pretty much 100% win rate currently, apart from when he didn't follow his own strategies. So especially for people with smaller accounts, and I'm not saying that for Mehdi, I'm just saying in general, using strategies like that, or that one in particular. I mean, I have my own system back in the summer of 2020. It was a lot more basic than what Mehdi's doing right now. But when I had a much smaller account and I was trading with much less money back then, finding a low time frame system that you can repeat day after day after day after day can really help you compound gains. Because what a lot of people try to do with smaller accounts is they just try a bunch of different things. And they just try and, go for the huge trades, try and get 500 to 1,000% profit on options. And a lot of people can do that successfully. But the issue with that is, if you're going for those huge plays, it puts you in a position where you stop managing risk as much as you might when you're just following a system. So I think definitely combining what Mehdi's doing with that strategy, with what 5150 said about spreads, what Keanu was talking about on the patterns. Go ahead.
To speak on that. He's back now.
Yeah,
I'm here.
Yeah,
I'm here.
So I'm going to get back to that in a second, but Neutron also, he was talking about how you can automate that. So there's so many different ways in which you can create a system, and I think that's the main thing that I want all of you to get from this workshop. It's like making that system for yourself, no matter what your account size is one of the best ways to go about growing consistently. And that really should be the main goal. Again, this is not financial advice, but for anybody here who's focused on long-term success in the market, you have to find a system that you can repeat. So you can remove your emotions out of that equation, and that's so you can help yourself manage risk. Because if you're just doing random things all the time, your risk management is going to be suffering from that. So that's another point I want to get across. And 5150, Mehdi was talking about Bollinger bands squeezing together. And I know you were talking about the iron condors for betting on or trading the decrease in volatility. So Sunny Money kind of answered this, but what are your thoughts on like the best strategies for playing volatility increases to either direction?
So in those, I do a spread the opposite. So I would do like one of a defined point. Like if I thought the resistance was at 150, it won't go below that, then I would sell a premium underneath that. I could play it that way on the Bollinger Band. And then the Bollinger Bands, what I'll use for the iron condors, are the ones that are super wide. Like if you look at Tesla on the daily, and when you're doing the condors, you got to look at the daily and the weekly, because you're usually trying to do them a little bit farther out on those. Not like a day trade. A day trade is a little bit different, but like if you look at Tesla Bollinger Band on the daily, it's pretty wide, so it should decrease, and that's what I'm trying to play off of those wings.
Perfect, thank you. And then another point I want to touch on is, I think maybe TheLump could speak on this, and maybe Neutron could help out a little bit as well. But automating a system, trying to make your own scanner and personalize your system in a way that you get alerts whenever something happens. For me personally, I really don't understand much about coding or any of that, so the only thing I really use is on TradingView. I could pull this up really quick. Let's see. Actually, I'm not going to, but
there's to Champ's point. That's really where everybody is traders. You only have so many hours in the day, and you can only look at so many charts. And you are a fallible human. You can look at things and get cross-eyed, or not have your coffee, or had one too many White Claws while charting and trading crypto. And you're looking for repeatable results, and the way you do that is get the computer to do it. Use the built-in tools. The indicators are just drawing things that you could draw, but it takes you out of the picture. So that's all an indicator is literally code. You can write. Lump can tell you the code. We've shared it. It's out there. It's not secret sauce to make Bollinger Bands on a chart, or to figure out where divergence is. So I encourage everyone Python is easy to learn. There's free data out there. I really encourage everyone to try and augment and step up their trading game by throwing a little bit of code at it. Whether that's you go learn Python and make your own thing, your own scanner, you get into some internal channels here in the free trading movement, or whether you just learn PineScript and pick some of your favorite indicators and click the little brackets next to the indicator, open it up and look at the code and try and change it. Maybe you want wider Bollinger Bands to take a strategy like 5150 says. You can just kind of play with the numbers and augment your skills.
I just wanted to touch on one more thing. For the people on the Discord, if you guys go to the chats and go to options trade, there's a little thread that says quick options scalp test, and literally TheLump has been posting. Let me just go back up top. TheLump has been literally posting every time like things would hit the upper band or lower band, etc. So like you'll see Roku lower band, MU lower band, Amazon. Like every single time we're doing this, he'd post if it's in the upper band or lower band, so you don't have to go through the whole list yourself. He's basically using the scanner for it to find the upper band and lower band, and all you have to do is just double check with the SPY, VIX, and QQQ and make sure that the market is in your side before taking a position. But one thing I wanted to mention with the strategy, you don't want to trade between 9:30 to 10 o'clock, because that's the most volatile, and a lot of the times price is just going to move up and down way too quick. You want to kind of trade between 10 to 3 o'clock. And between 3 to 4, a lot of times the movement goes by too fast and it might not always follow the Bollinger Bands or follow certain indicators. If there's a huge sell-off or, you know, just people buying like crazy right before market closes. So you kind of want to trade between those periods for like the best success with that strategy that I went over with. But yeah.
Thank you. And Lump, I got to hear something from you. What's your thoughts on you know, how things have been going? What have you been looking for?
I think Neutron covered a good portion of it. What I'm just trying to do is really automate most of the trading as possible. I'm really far from taking trades automatically, but what we've done so far with Mehdi at least is Mehdi shared his I guess his sauce or his technique or whatever. His and syrup. What I've been able to do is what? Oh, his syrup, yeah. And I basically made the computer, instead of Mehdi having to have his eyes on all 50 tickers and the indices and all the TA and all the indicators and whatnot, I make the computer do that every single 5 minutes and within a few milliseconds. And that way we save time, we save some sanity. Especially when you're trading on a 5 minute, the variables can change so frequently. And having the computer do that for you saves you a lot of time. And as some of you may know, you can apply this to mostly any trading strategy that you may do, whether it be swing or 5 minute option trading. I post daily divergences on the watchlist scanner channel. You can apply that to 4 hour, you can apply that to 1 hour, anything. So the only thing is, I you know, it's hard to explain it because you have to know how to code. So I guess if you are interested in that sort of thing, then yeah, what Neutron said, pick up coding. It's pretty easy to say it, but very hard to do. You'll have to be dedicated and, you know, stick to your plan. But yeah, you have to know how to code first. And just because we're automating does not mean you should not understand the technicals, the ideas behind it. You can't blindly trust a computer yet, unfortunately. We're not at that point yet. But yeah, you have to, once the computer tells you something, you have to be able to open up the chart and verify that yourself, because you don't want to be blindly trusting a computer yet. Yeah, that's basically what I do. And whenever I have time to run the scanner with Mehdi, we usually, like he said, post in that thread. So if anyone's interested, you can just join that or keep an eye on that thread. And when we post, then I'll be posting live whenever something's at the top or the bottom with divergence. And then another thing is, if anyone has any requests for some sort of scanner, feel free to DM me or message in social chat. Whatever it may be, some TA thing, like for example, what I do, who has daily divergence or who has daily potential bullish divergence. If you have something like that, feel free to DM me. And if there's enough requests, then I can think about implementing it. That's about it for me.
Perfect, thank you. And then one other thing, I know 5150 wants to speak about something in a second here.
Yeah, I was going to add to the Bollinger Band thing too, because some questions. So here's another way to trade Bollinger Bands when they tighten up, right? The whole purpose of Bollinger Bands, like when they start to get tight, is they're going to expand in one direction, right? You're basically accumulating. So it's tightening to kind of have a violent expansion, right? Is usually the way that I see them. So you don't know which way that's going to go. And trading in between the Bollinger Bands is kind of like trading in a range. So therefore, you kind of don't really know where it's going to go. So what I would do, and I don't suggest this for newer traders, but you can definitely try with paper trading, is you can sell a premium put or call into that volatility. So after it expands and it goes up to the top of the Bollinger Band, right? You're at 2 standard deviations or whatnot. That is a great time to sell a call or put against it at max premium, because the volatility is high. And when volatility is high, the premium's up. I don't want to touch it before it goes off, right? That also can be my first leg of the iron condor. So I can wait until a big explosion of price action that comes through, and then okay, I see it. It's at the top. There's a resistance, or it's at the top of the Bollinger Band. Now I can sell that call or spread against it and say, oh, let me collect that premium. It's at 160 at the top. I'm going to sell a 170 call, and now I'm expecting it to come back down to the middle. And as it comes back down to the middle, if it breaks through, I can do that on the opposite side. And now I can create an iron condor out of two different trades, right? That's how I would trade it with the Bollinger Band on those. I wouldn't trade it before that, because in the middle, when it's starting to tighten, you're expecting a breakout of some sorts usually.
Yeah, perfect. There's just so many ways, in the market every single day. Something's going to move, something's going to be flat. But you can always put yourself in a position as a trader where it doesn't matter what happens, you're going to be able to profit, but you just have to be in the right place at the right time. And that's really what I think it's all about. And then obviously your knowledge has to back that, and you have to work every single day to increase that knowledge, right? Success is where preparation meets opportunity, right? I think Mitch Ray says something like that as well. It's like, you can be the best trader in the world, but you also have to put yourself in the right place at the right time. If you're not putting yourself in a situation where you're spending hours and hours looking for the right opportunities, you're only going to take the lower opportunities because they're easier to find. But really, you have to put in a lot of work to find the situations and where you can profit most with the least amount of apparent risk. So that's how I look at that. Does anybody have any questions about anything that we've talked about so far?
I have any questions?
Yeah, I have a question.
Yeah, go ahead.
I was wondering if you had that scanner available on TradingView as like a plugin of some sort that we can use, or is that kind of more private?
It's not private. I posted the source code. The only issue is TradingView has a specific programming language that you need a code in, and I do not know that language. So I've done it in Java. So the way I run it is just locally on my own computer. So unfortunately, it's not on TradingView.
And do you have like a preset of tickers there that just kind of constantly looks for those opportunities at lower or upper band Bollinger Bands?
Yeah, that's a good question. So you can. That's the good thing about scanners is it's kind of like plug and play. So you can say, okay, run it for all stocks over 1 million volume, or you can say run it only for the biggest market cap stocks. So for the divergence, I have it currently set to run for stocks with over 800K volume per month. And then for the BB, for the Mehdi strat, I just follow whatever stocks he suggested. But I think he's open to adding more there.
Yeah, I'm open to adding more for sure. Just as long as it's liquid and like the options like move, because a lot of the stocks is like some stocks that the spread is too big, so I don't bother trading them. But yeah, as long as like the spreads is good and it's pretty liquid, then I'm down.
Yep.
All right. Any other questions?
No, I didn't have a question, but I had a note here that I didn't go over. As you had mentioned, confirmation for options flow. You were looking at trading ticks and the options flow. The other thing out there that is an indicator to give you additional confirmation is social sentiment. And there are some open source things that you can go out there. If you wanted to look at the coding and do Python, you can go to GitHub and download stuff and scan Twitter, scan everybody, scan your stuff. But there's something out there. I don't think we're affiliated, but ChatterQuant is another service that only looks at social media sentiment. And so if you get yourself in a place where you've confirmed a thesis with price action, volume, TA, options flow, and social media sentiment, that's a home run. Not financial advice. But that's all I had to add.
Perfect. All right. Well, I think that's going to be it unless anybody has any more questions. Just want to give a huge shout out to Keanu5150, Neutron, TheLump, Mehdi. thank you all so much for speaking. I just asked all of them and they were all very open to it. And yeah, they literally made the workshop. So thank you all so much. I'm going to be ending the recording right now. I think it's about like 2.5 hours long.